in the interests of time, let's kick off the session. So a big welcome and hello on behalf of myself to this half day of training on applying the IFRS Sustainability Disclosure Standards. This program is truly a very collaborative effort, really driven by that demand we're seeing in the market for more capacity building on the implementation of the IFRS S1 and S2 standards. So firstly, a big thank you on behalf of myself and the SSE team to our colleagues at the IFRS Foundation, at the IFC, and our other partners for taking part and supporting us in this program. And of course, a big thank you to you as well for joining us as participants in today's training session and taking that time out of your busy schedules to take part in this capacity building session. Okay, so fantastic. So I'm very pleased today to see that we have two opening speakers joining us. Richard, just to say, I had you first in the agenda, but I see you're on the move, so I just want to check, is it good from
Um,
your side?
yeah, all good. I'm here.
Great. Okay, fantastic. Thanks, Richard. Great to have you with us. So, Richard Barker is a ISSB board member from the IFRS Foundation team. So, a big thank you for joining us, Richard, and I'll pass over to you to kick things off.
Fiona, thank you very much. Yes, I am on the move. So greetings from Hyde Park in London, where I'm on my way to a conference this morning. Actually, the conference itself illustrates the importance of outreach and communication and so on from the foundation, and the importance of capacity building. So there's two of these things going on simultaneously. We're a standard setting body, the IFRS Foundation, but actually our first few years has been mostly around adoption and capacity building. Sustainability reporting is such a new thing, that building understanding and awareness of what it is and how it works and so on is so important. Just to illustrate how and why this matters, there is a very well established body of professionals working in sustainability and sustainability impact and management and dependencies and so on. There's also, of course, underlying conservation science and climate science and so on behind that. There's also a very well-established body of professionals working in financial reporting and in assurance and accounting and all the rest of it, capital markets, investors. And those two worlds have come together because sustainability-related dependencies and impacts create risks and opportunities now in a way they didn't do not so many years ago, and those will only grow over time. And so those two worlds need to be able to understand one another and speak to one another, and that's what sustainability reporting standards are in effect all about. So if you're a sustainability professional, you think of materiality in terms of is there a material impact of the business on some aspect of sustainability? It might be quite on a small level, it might be quite localized, and it might be an effect on other stakeholders and not on investors. But that's materiality in that world traditionally. If you're a capital markets accounting person, materiality is information sufficiently important to make an investment decision when disclosed on capital markets. So very different concepts, and they come together in this space. So building awareness that sustainability reporting is about entity-specific material information concerned with how sustainability-related risks and opportunities affect investors' decisions. That's where it all comes together. It's relatively straightforward as a concept, but actually requires quite significant development, training, changes in mindset, not least, in how to think about all of this. So, for example, and I'll stop with this example, accountants think about control, they think about measurements, they think about reliability and so on. Those are all important attributes, but built into sustainability reporting is much more of a future-looking perspective, a willingness to accept estimation and to explain estimation and to use judgment. And so those things go outside the sort of the comfort zone of traditional financial reporting, but are absolutely core in sustainability-related financial disclosure. So Fiona, thank you. It's really great to have this program. Great to have the level of interest that there is in it, and I hope you have a good session. Thanks.
Fantastic. Thank you so much, Richard, for setting the scene so well there and wishing you the rest of a good walk across the park and a good day. So thanks very much for joining us there. Fantastic. Brilliant. So great to have Richard kick that off there. But I'm very pleased as well to say that we have a second opening speaker joining us today from our second partner organization for this program, the IFC, part of the World Bank Group. So a big thank you to Yulia Kolodkova also joining us, who is a corporate governance officer, and she's the project lead for the IFC's ESG advisory project in Ukraine. So Yulia, many thanks again, and the floor is yours.
Many thanks, Fiona. Can you hear me okay?
Yes, we hear you well.
Yeah, thank you so much. And thank you to Richard for this opening remarks. Good morning, good afternoon, everyone. And can you believe or not, but at some point, I also was a participant of this training when it's started. But now it's my pleasure to join with my welcome note because I see relevance of this event, right? Because this is like really a great opportunity for everyone to learn, to share views, and to implement it at certain point. So this session is reflecting really a strong partnership among couple of institutions, which are UN Sustainable Stock Exchange Initiative, the IFRS Foundation, and IFC Beyond the Balance Sheet program. Together, this program was launched back to January 2025. It's called ISSB Training Program. And since then, this program reached out to more than 25 across 35 markets. And this scale is possible because of this effective collaboration, because it brings together global expertise. It's also consider local relevance. And of course, this is your commitment of the participants to improve disclosure. Because now we are not talking only like about the existence of disclosure. We are now talking about sustainability. We are now talking about the quality of disclosure. If we look back back to the beginning of the start of this program, the first workshop on February brought together more than 1,200 participants. And in follow-up session with the Johannesburg Stock Exchange, we had more than 500 participants. But today, the number is growing because what we've seen, like more than 1,900 participants registered, and now I think we will be close to 1,000, right, Fiona? I hope, and fingers crossed for that. So this really demonstrates the relevance of the topic and the urgency of this topic, right? Because we have plenty of frameworks issued and requirements established by regulators. So this is something that could be relevant for everyone. And of course, I would like to note that today, as of today, more than 30, like I think around 40 jurisdictions have already adopted or in process of adopting these standards. And we in IFC, we are supporting currently supporting more than 10 of them, including South Africa, Peru, Bangladesh, Nepal, Jordan, and Pakistan. And this is basically done through the corporate governance program, and the one I'm representing currently launched in Ukraine. And this work is specifically important for companies and banks because they have a role, right? They have a role in promoting these principles, in promoting these standards, and in some cases, like serving as a role model for others. And really, it's contribution to the entire economy. I just want to mention our IFC flagship program, which is beyond the balance sheet program. It's aimed to help strengthen transparency, sustainability, and reporting in emerging markets. This is basically based on the Disclosure and Transparency Toolkit, and we have e-learning program available. So this is basically how we are trying to motivate, right, and to support people who want to do more in terms of disclosure. So, and I believe that your participation today also demonstrate a strong commitment, right? Once you decided to join this morning for the session, this is commitment and commitment for disclosure. So basically, I want to just mention that today you will have a really great cohort of experts, and this is your unique opportunity to listen to them, to engage with them, to ask your questions, and maybe to exchange opinions with your peers who are attending today. So I wish you good luck with this session, and over to you, Fiona. Thank you so much.
Fantastic. Thank you so much, Yulia, for joining us and for those wise words. Indeed, great to make the most of this opportunity. And thanks for that encouragement to our participants there. So many thanks again. Okay, fantastic. So from my side, a few housekeeping and practical points just to talk through before we kick off and get into the course materials. So firstly, on a practical note, you've probably noticed by now that you're muted as participants, but that doesn't mean that we don't want you to take part and engage in the session. So it's great to see so many of you sharing your comments in the chat as we move through, so feel free to continue to do that. But if you have particular questions for the team, please make sure to put those in the Q&A box because that will allow us to track and respond directly to your questions there. So please do make use of that opportunity to ask your questions as we move through the session. In terms of our format today, so we've got a live 3.5 hour session. We'll take a break in the middle of that, and there'll be an optional homework exercise which we'll talk you through as well. As we've said, really make sure you're using that opportunity to ask your questions throughout the session. And we really do encourage you to participate and be active as learners in this training. So we'll be using a number of interaction tools, including Menti and Zoom polls. So please do take part in those. And finally, you probably know that if you take part in today's training program live, you're able to receive a completion certificate. To get your certificate, you'll need to fill out a survey, which we'll share with you at the end of the training session. So in terms of who's delivering your training today, so my name's Fiona and I'm joined by my colleague Tiffany Grabsky, the head of the SSE Academy, and we'll be facilitating the SSE. We're also joined by our colleague Landon, who'll be supporting us in the chat as well, so thanks Landon. And alongside us, we're very pleased to be joined by our colleagues from the IFRS Foundations Capacity Building team. So many thanks to Robert and Vanessa, who'll be speaking and facilitating today. And alongside them, they're joined by their colleagues Rebecca and Visvesh, who'll be supporting with answering your questions as well. So many thanks to all of the IFRS team for joining us here today. So we've got 3 key learning objectives that we're hoping to achieve with you in today's session. So firstly, we'd like to help you to understand the ISSB standards. Secondly, to understand how you can use and put into practice the ISSB standards. And finally, to identify the steps that you can take to develop your organization's own disclosure plan to apply the ISSB standards. Great. And so how that breaks down is into 4 core modules that we've developed to help walk through those different objectives. So in our first module, Prepare, we're going to be thinking all around the purpose and the case for sustainability reporting. We'll then move into our second module, Align, and think about how to apply and use the standards. In Implement, we're going to be focusing all around practices and systems to integrate, evaluate, and identify sustainability-related risks and opportunities. And then finally, in Communicate, we're thinking about the final format of our disclosures. So how to report, where to report, and how to do so in an efficient way. And so this just shows the same information, but just breaks it down over the agenda for our session. So you'll see how those units break down across the time, and we'll take a little bit of a break in the middle as well, just to refresh ourselves before we wrap up at the end with some additional resources you can take away. So an important point to mention, and I know it's a question we'll probably see a few times, you are able to access all of the training materials from today's session on the SSE webpage. So I'm sure my colleagues have shared it already, but we'll share again in the chat the link to this. And on that event page, if you go to resources, you'll be able to find the slide handout from today's presentation and also the homework exercise. And those slides will include links to all of the resources that we're sharing in the chat with you. We'll add a recording of the training to that page after the session as well. And as I've mentioned, we also have a homework exercise. This isn't a mandatory activity. It's really about helping you to progress what you've learned today in your own organizations and develop that disclosure plan. So you can access the homework from that same page that we've linked to, and we'd encourage you to use that to continue your learning journey. Couple of final things to mention is the SSE toolkit. So we've developed a toolkit of different resources to support you on your sustainability related financial disclosure journey. So you can find these resources by clicking that QR code or scanning that QR code, I should say, that you see on the slide. Or also going to the SSE web pages. And we've developed a range of tools here that can really support you to develop your disclosures, and particularly the gap analysis checklist I would highlight is something we'll talk about a number of times in today's training, which is a helpful way to understand what disclosures might be missing for you currently and how to move forward from that. Okay, so just to round off our opening segment, we'd like to hear from you all in Menti. So this will just get us used to using Menti for later in the session, but it's also really useful for us to get a sense of why you're joining us today and how much you might already know about this topic. So my colleagues will share the link to Menti in the chat, and I'll just share my screen now as well, so you can see how else you could join us. So a couple of options. You can either click that link, you can use the QR code you see on the screen there, or you can finally go to menti.com and enter that 8-number code that you see at the top of the screen and on the right-hand side as well. You can just let us know in a couple of words why you're joining us here today and what you're particularly interested in to get out of today's session. Okay, so I see sustainability reporting, that it's part of your role, learning, upskilling, interest, relevance, application, quantification, climate reporting, I see. Maybe mandatory reporting is something you're being driven by. We'll get into that in a little bit. Looking for new skills, ESG knowledge. Fantastic. Thanks, everyone. So hopefully lots of things that we'll be able to support you with in tackling today, but lots of good motivations for joining us in this session for sure. Okay, I'll move on to our next question, just in the interest of time. And we'd just like to get a sense from you all as to how comfortable or familiar you are with these different tasks currently that we're aiming to talk about today. So firstly, explaining to your colleagues what the ISSB is. Secondly, on using the ISSB standards. And then finally, on developing a sustainability reporting strategy. So you can use those sliding scales that you see there in Menti to take a vote as to how comfortable or confident you currently feel on those different areas. So I see we've got 100 or maybe 300 total people in Menti and 200 of you voted. I see we're almost at 1,000 in the session, so it's great if as many of you as possible can join us and take part in these interactions, as we'll come back to Menti a number of times more. But from those of you who voted, I think we see maybe a middle to slightly lower end confidence at the moment, and perhaps least familiar with using the standards themselves. So of course, that's very natural, and that's what we're aiming to help you progress today in our training session. But thanks for letting us know where you're currently at. So we'll use Menti a couple of times in the session. So encourage you to keep that link that you have now open as a tab, and we'll come back to that to do some more questions later. Great, but for now, from my side, let's kick off and get going with our first segment of the training content. So before I do, just a quick disclaimer to share with you all, which is really just to be clear about how we're going to be using company examples in today's session. These are really simply here to help add some color to what we're talking about, but these shouldn't necessarily be seen as the best or the right way for companies to approach this. And of course, each company needs to take their own approach as fits their circumstances. So with that established, we'll now kick off with our first module, Prepare. And in this module, we like to cover 3 different aspects in our units. So in our first unit, Purpose, we're thinking about building a solid foundation of knowledge. And we generally are focusing here on understanding the case and market drivers for reporting. When we move into landscape, we're thinking about how the current reporting landscape has evolved and how we've then developed the global baseline of the ISSB standards. Okay, so getting into our first segment on purpose, we have a quick poll question for you all, just to get a sense really of what your current drivers are for thinking about this topic or maybe already progressing sustainability reporting. So you can vote for as many of these options as are correct for you, and let us know which of these drivers is particularly relevant for you. Okay, so I see quite a good response rate to this, so that's fantastic. So great to get as many of you taking part as possible. And let's give you a few more seconds to respond before we look at the right answers, or not right answers, sorry, look at the responses that you gave us here. Okay. I think we're seeing quite a clear picture emerging. So I'm going to end the poll there and I will share the results. So it looks like for many of you, regulatory drivers is a big factor here and one of the main reasons to focus on this, but also quite a large proportion of you are mentioning investor interest as well as a second driver. And then some more so of you thinking about how to share your own organization's objectives or manage kind of peer and competitor expectations as well. So a mix of drivers, but overall kind of regulation and investor interest looking to be the top ones. So thanks for sharing that with us there. All right, so let's move in then to the next section. So really thinking then about that investor perspective that we talked about there. I think a useful data point here is the number of signatories who have signed up to the principles for responsible investment. And we now see more than 5,000 signatories to these principles, a really substantive increase from where we were perhaps 5 years or so ago. And so what is it that's driving this investor interest in sustainability related issues? Well, I think what we'd really like to highlight here is that a key driver behind this demand from investors is the potential financial effects of sustainability related issues and the growing recognition that for companies, sustainability issues are highly relevant to long-term value creation and strategic resilience. The data you're seeing here comes from a recent study of institutional investors, which was conducted by HSBC. And in this study, they found that the top driver for investors to incorporate climate change and environmental issues into their strategic performance was the perceived impact of those factors on long-term value creation. And so you can take a closer look at this study by following the link in the handout. But before we move on, I've talked a little bit there around kind of financial performance, and there's a few key terms here that we'd like to be clear on upfront. So firstly, one thing we're going to be talking about here today is effects on financial performance. And we're going to talk a bit later about this topic, but to be clear at the start, what we really mean here. We're talking about effects on a company's performance, which are reflected in its statement of profit or loss, which will show its income or revenue and expenditure. And so sustainability related risks and opportunities may have a financial effect by potentially changing the revenue mix or total revenue of a company. For example, if there's a change in demand for its products and services, and we can also see substantial changes in expenditures as well. For example, a company's operating costs might be impacted by rising energy prices, or it may need to take greater investment in R&D to capitalize on new sustainability-related opportunities as well. And another thing we're going to talk about a few times today are effects on a company's financial position. So here we're talking about the reflection on the company's balance sheet, also known as a statement of financial position. And here, for example, a company could experience changes to certain assets or liabilities due to climate or sustainability issues. So we could see changes in portfolio value, or we could even see write-offs of certain assets that perhaps are damaged or need to be repriced. And finally, we could also see changes to financing and the cost of capital as well. So this could include, for example, equity valuations that could be impacted by climate risks, and also making use of new financial structures such as green bonds or social bonds as well. And so before we move into our next unit, just a few final key concepts that we wanted to flag up relating to sustainability risks and opportunities. And so before we jump in, it's worth noting that the ISSB standards are designed to help companies identify and communicate its own specific sustainability-related risks and opportunities. But we'll look first at the global picture to help us understand these concepts. So you'll see here data that you might have seen before from the World Economic Forum's Global Risk Report. And this really shows us that risks can evolve over time. So those risks that are high on our priority list in a short-term time horizon could be quite different from those risks that are over a 10-year time frame. And as you can see here, if we look over that 10-year time frame, environmental risks and social risks are increasingly coming up the agenda. And when we're thinking about our disclosures here, what's important to consider is that if we're preparing now for those longer term risks, we might need to take action today to do that, which could result in kind of information relating to financial investments or mitigations that we have to put in place now about those longer term risks. And another key concept just to highlight here is that interconnectivity across sustainability related risks and opportunities. We see another visual here coming from that World Economic Forum report, which is really just showing that interconnection across different risk types. So whilst many people, of course, may think of the two ISSB standards as separate standards, one for climate and one for other sustainability topics, what we can see here is that, of course, many sustainability related risks and opportunities can be interconnected and interdependent and inform each other. And so therefore, again, when we're thinking about our disclosures, what's important is that we try to think about the whole when we're making strategic decisions and developing our sustainability reporting. And so, in fact, in IFRS S1, there are a number of conceptual foundations for ISSB disclosure, which include requirements relating to connected information. And this is really all about ensuring that our investors get a holistic picture of the company's overall sustainability related risks and opportunities and how they're managing those. Okay, fantastic. So that is the end of our first unit, and I'll hand over to Tiffany now to take us through our next one.
Great. Thanks so much, Fiona. And hi, everyone. Nice to see you all. We're at full capacity now, so hope you all get a stable connection and can stay in the remainder of the training program. But just as a reminder, the recording is going to be on our website if you do lose a connection at any point. Let's dive in now to the next section. Fiona just covered briefly kind of why we're working on this. So let's look a little bit more about what we're working on in the evolution. And to start off, I would like to do a quick poll and hear from all of you. Now, I'd love you all to participate. We have a lot of you here, so please take the time to participate in this poll. We want to hear from all of you. And let us know what standards or frameworks you're currently using to disclose. Now, I see already some of you are saying you're using the IFRS S1 and the IFRS S2, which is great. And hopefully you're here to further enhance your knowledge on this. So we expect some really good questions from you all. There's also a lot of you that are using GRI, and I see in the chat too, some of you are answering. That's great. Some of you are using integrated reporting. Also, some of you are using SASB and TCFD. And a few of you have indicated ESRS. So we're now more than half of you. I'm going to give you 3 more seconds. So quickly pick those options you want to pick, and then I'm going to end the poll. 1, 2, 3. Great. So we nearly had 600 of you reply. So I think we have a good sense now of where all your experience lies and what you're working on. So as you can see, really our top kind of frameworks being used by this global group is the IFRS S1 and IFRS S2, as well as GRI, which I think you'll see in this training work very, very well together. That's great. Thanks everyone for participating in that poll. Let's move on now, and we'll just take a moment to understand what the IFRS Foundation is and how this ISSB, the International Sustainability Standards Board, came to be. So the IFRS Foundation is a not-for-profit public interest organization established to develop high quality, understandable, and enforceable and globally accepted accounting and sustainability disclosure standards. And the IFRS Foundation hosts 2 independent standard setting boards. So they have the International Accounting Standards Board, or IASB, which was formed in 2001. And these standards are in place in over 140 jurisdictions around the world. And then they also have the International Sustainability Standards Board, or ISSB, which was formed in 20 years later in 2021. and released its first two standards in 2023, following really strong market demand for this establishment. Now, those two standard-setting boards work closely together to ensure that the financial and sustainability standards definitely complement each other and work together. And then governance for these standard-setting boards is provided by trustees, who are in turn accountable to a monitoring board of public authorities. Great. So here is a number of logos that you might be familiar with. And based on that poll, I think a number of you are. All of these organizations have contributed to the evolution of sustainability reporting up to today. In fact, they all have a lot in common, but the range of objectives and guidelines and standards on offer has caused some confusion in the market. Sometimes people refer to it as an alphabet soup. Most of these organizations here focus on meeting investor needs for sustainability information, except for GRI, which supports a broader range of stakeholders. Now, some of these organizations were then consolidated into the IFRS Foundation to form the basis of the IFRS Sustainability Disclosure Standards. The standards were also built on top of the TCFD recommendations. So those of you who have been reporting in line with TCFD, and those not familiar with that, it's the Task Force on Climate-Related Financial Disclosure. You will also find the standards here very familiar if you're already familiar with those. For this reason, the publishing of the ISSB standards also marked the culmination of the TCFD's work, and the TCFD has now been disbanded. Meanwhile, CDP's climate questionnaire, which some of you might use, is now aligned with IFRS S2, which we'll discuss a bit later what S2 means. And also the IFRS Foundation has also agreed to take over responsibility for the disclosure of specific materials from the TPT, the Transition Plan Task Force. Now, as a result, the reporting landscape has now been significantly simplified. There is more harmonization and simplification work going on in order to continue this development and to publish more guidance materials so that everybody understands what is the role of each of these organizations and which ones they should be taking advantage of. Now, let's do another poll. Again, I want to see you all participating in this poll. Here, I want to ask you, what do you think are the differences between reporting standards and frameworks that still exist? So they exist due to differences in reporting objectives, in scope, in definitions used or wording used. And of course, those definitions and wordings probably have to do with different objectives or different focus. We also have materiality focus that might differ, or maybe there's other reasons that you think we have still a few different standards or frameworks for sustainability reporting. I see someone says difference in terms of mandatory versus voluntary. Sure, and materiality focus. Yeah, we hear that a lot. Great, we're getting a lot of answers both through the poll and in the chat. Someone says, are you going to launch the poll? It has been launched. So if you can't see it, maybe you're on your phone. Try swiping to another screen. Great. So I'm going to end the poll here. I think we got a good number of answers there. And I'm going to congratulate all of you because actually all of the answers were correct. So congratulations to everybody who answered that poll. Indeed, these are all factors that explain why different reporting frameworks still exist, and different standards were developed to meet these different policy and regulatory objectives in order to promote disclosure on different topics also, and to serve different materiality perspectives and different stakeholder needs. However, as we've discussed, there are these ongoing efforts to harmonize the reporting landscape. So we're going to talk a little bit more about that today to make this a little easier for everybody. So first, let's start on TCFD. So remember, that's a Task Force on Climate-Related Financial Disclosures. So an investor-focused framework, and in some markets, a listing requirement. This got a lot of traction in recent years. So many companies are now asking what's next for their TCFD reporting, as TCFD has disbanded, as we mentioned, handing over responsibility for monitoring progress of companies' climate-related disclosures from the TCFD now to the IFRS Foundation. So companies should continue to report against the TCFD if they are required to do so, if it's a listing requirement or regulatory requirement, until they're advised differently by the relevant regulatory authority in their jurisdiction. That said, S2 fully incorporates the TCFD recommendations. So a company complying with the IFRS S2 should not need to prepare a separate TCFD report. And because the ISSB standards incorporate the TCFD recommendations and use the same architecture as them, any company that has prepared a TCFD report is well placed already to complete the few additional steps to fully adopt the IFRS S1 and IFRS S2. Just to note, we will be sharing 2 links and you can access them in the slides on the handout. There's also this comparison document you can make use of if you are using TCFD to understand how these are the same or different. Now, setting a global baseline. The ISSB is focused on developing standards that can provide a common language and therefore a global baseline for sustainability-related information. It wants to enable comparable and consistent sustainability disclosures across global markets, and the foundation works with jurisdictions around the world as well as other stakeholders to achieve this. So regulators and stock exchanges are able to require companies to disclose further information by adding their own additional building blocks tailored to their needs, for example, stock exchange guidance on disclosures. And additional disclosures can be required as long as that information is presented in a way that does not obscure the required disclosure. So we still have to be able to understand everything that IFRS S1 and S2 are asking to be disclosed. So keep this in mind as we move forward today, that the ISSB standards should really be seen as a building blocks approach, something that you can build on top of with other standards and frameworks. Great. So following the launch of the ISSB standards in 2023, the International Organization of Securities Commissions, or IOSCO, announced its endorsement of the ISSB standards, and IOSCO asked their 130 members to consider how they can incorporate the ISSB standards into their regulatory framework. And we also see that the foundation continues to engage with other stakeholders on adoption and related issues, for example, with the IAASB on a new assurance standard for sustainability disclosure, the ISSA 5000. Also, as part of its regulatory implementation program, the foundation is supporting multiple jurisdictions with planning and preparing for voluntary disclosures. So I think we can see here that this kind of baseline or building blocks approach is quickly reaching the regulatory realm, and we're seeing it all around the world. So I'm gonna, with that, pass on to our colleagues at the IFRS Foundation. Robert, thanks for being here with us today, and I'm gonna pass to you for the next section.
Great. Thank you very much, Fiona, and welcome everyone. My name is Robert Switowski from the IFRS Foundation. I'll be then taking you through the next section of this module. We talk about the business case and the market case for sustainability reporting and the evolution of the landscape and how it's being simplified and rationalized. So now let's introduce the standards themselves, IFRS 1 and S2. Before we could go into details, let's take a note of some key terms that should be understood here. You can find the definitions in the handout, but I want to briefly mention them here. So first of all, we'll be saying the phrase sustainability-related financial information quite a lot. This can be information about broad set of issues, including climate, nature, of all biodiversity, human and social, or others. So that's the first one. Secondly, the sustainability-related financial information is information about companies' sustainability-related risks and opportunities that is useful to investors in making decisions about providing resources to the company. So it's an important distinction because that differs from the other standards. So remember this key element and factor here, that this information needs to be useful to investors. And secondly, what is meant by this? So these are sustainability related risks and opportunities. These are those that could reasonably be expected to affect companies' cash flows, access to finance, or cost of capital. So in other words, that could affect the company's prospects. And then the other important term we'll be referring to quite often is general purpose financial reports. And this will then include the company's financial statements and management commentary. And so you might know this as a management report, management review, management discussion and analysis, or strategic report. And some regulators require specific disclosure in certain parts of general purpose financial reports. So we will then use this generic term throughout. So here we are just summarize some key terms of each key points of each term, but you can refer to S1 for a fuller definition for each of these phrases. They are provided there. So if you want to know that in details, please refer to the standards itself. All right, so now I'll be moving to the next element. So the key core content areas. As I mentioned before, anyone familiar with TCFD will recognize the same four content pillars or content areas as they are in the SB standards, and they are governance, strategy, risk management, and metrics and targets. For each content area, there are a set of key disclosures to be addressed, and the standards provide a very detailed guidelines and requirements on those. We will discuss each of the four in turns, and I encourage you again to download the standards as a part of your homework. All right, going then to the S1, and then providing you an overview of the standards. So to start, to all the preparers listening us today, let me start. Should not be afraid. There's a lot to understand indeed, but you might be surprised, positively surprised, that some of the details are already familiar to you. And to all the accountants listening, you also be relieved that many of the conceptual foundations are developed by the IASB, the accounting body, are also in the ISSB standards. So let's start with the title of the IFRS S1, and the full title is General Requirements for Disclosures of Sustainability-Related Financial Information. And so, as the title suggests, the S1 sets out general requirements for the content and presentation of the material information about sustainability-related risks and opportunities. If you're familiar with TCFD, again, you will see the same architecture applied throughout the standards. What is important to remember here for other matters than climate, S1 asks preparers to refer and consider the applicability of the SASB standards and other sources of further guidance to identify sustainability-related risks and opportunities and identify material information about them. The SASB standards are organized by industry, enabling companies to identify disclosure topics and metrics applicable to its business and operations. Finally, the standards work or can be used in conjunction with any accounting requirements, any national gaps. So that's about shortly an overview, a preview of the S1, so the general requirements, and now we're moving to the S2, so the climate-related disclosure. So as mentioned, S1 covers all sustainability-related risks and opportunities, and the S2 is specific and focuses on climate disclosures, building on the same foundation though as S1. So again, it fully incorporates the recommendation of TCFD, sets out requirements of a company to disclose material information about its climate-related risks and opportunities, and it requires the disclosure of both cross-industry and industry-specific information. In terms of climate-related risks, this includes both physical and transition risk, to which we will come back later. Other specific climate-related disclosures in S2 are, for example, scenario analysis and greenhouse gas emissions, which we'll be talking again later on. And again, prepares must also refer and consider the applicability of industry-based guidance on implementing S2, such as the SASB standards. And as mentioned, as same case as one, so this is organized by industry and enabling the company to identify climate-related disclosures, topics and metrics applicable to its business. Yes, so these are S1 and S2 as a snapshot, and let's then talk about how they relate together. We had this question in Q&A as well. So it's important to mention here that the S1 and S2 are not standalone standards. They are together a package and must be applied together. Even with the companies reporting only on climate-related risks and opportunities, the company must apply both S1 and S2. This is because the S1 sets out the general requirements or parameters for the type of information that needs to be provided in order to be decision useful for investors. So also S1 explains the concept of materiality and how companies identify material sustainability related financial information. Moving further, we'll then look and consider some of the conceptual foundation, the basis of the standards which they underpin the IS1 and S2. They might be new to anybody who without an accounting background, but the ones who do have accounting backgrounds, they should be fairly familiar. So these concepts help us to understand how best to disclose information in order to meet the requirements of the ISB standards. So to start with, companies must fairly present a complete set of sustainability related risks and opportunities. And the fair presentation in this case means that it also requires disclosures to be faithfully represented. And to achieve these, companies shall provide a complete, neutral, and accurate depiction of sustainability-related risks and opportunities. And again, please refer to S1 for the definition of those terms and the key points and the distinction between what is meant by these terms. The other important term or the notion is the reporting entity concept, which requires the organizational boundary for sustainability-related financial disclosures and financial statements to be the same. And thirdly, another important concept here is connected information. We saw earlier when Fiona was presenting, explaining how different risks are often interconnected and interrelated with each other. The ISB standards require companies to clearly identify the key connections, such as those between the risks and opportunities, between disclosures in the 4 core content areas, and also between the related financial disclosures and main financial statements. And to give you a little bit of a practical tip and overview and how this can be done in practice, we have an example. And today, Tiffany will present it to you. Over to you, Tiffany.
Great. Thanks, Robert. So this example is used here to illustrate those connections between a company's decarbonization and their investment processes. So building on that conceptual foundation that Robert was just talking to us about. So this is an extract from the operating and financial review section of BHP's 2024 annual report. And it is part of the disclosure on how BHP manages climate-related risks and plans to transition to a net zero economy. Now, this extract describes the impact of the company's climate-related risk assessment and climate scenario analysis on the business and its capital allocation plans. So how is information connected in this extract? Well, this extract illustrates connections between the company's decarbonization strategy, its financial results, and other processes used. And it describes the impact of the company's climate-related risk assessment and climate scenario analysis on, as we said, its business and capital allocation plan. So the first paragraph tells us that climate risk assessment and climate scenario analysis are integrated into the company's strategy, and they're treated as a sensitivity in their capital allocation process. Now, also connections and alignment between the company's capital allocation plans and a rapidly decarbonizing global economy are also considered here. So some assessments are still in progress. The company is undertaking studies to assess the effects of future physical climate-related risks on its operations, on its productivities and costs. And the results will then be used to inform and therefore connect with the company's risk profile, its corporate planning, its controls, also its adaptation measures, for example. Now, the light gray text here shows connections to further information on the impacts of climate-related risks on its operations activities, on its GHG emissions across the value chain, on its financial statements and production, and on its revenue and expenditure. So, in summary, this extract is just one example about how the effects of climate change are connected with decisions and plans about standard business processes on operations, risk, and controls and finance. Now, just to note, I should have mentioned this before the example, but we are using a number of examples. Someone was asking to see what companies are reporting on this. Throughout the training, we're going to show a number of examples from real companies and their reports. Just a short caveat that these are not to imply that this is exactly how you should do it, that this is best case example. This is to illustrate that companies are already doing this and maybe to start to learn from your peers about how they're doing it. But keep in mind that you should always do this however it fits best with your organization, not necessarily just because a peer is doing something, you should do it exactly the same. Now with that, Robert, I think I pass back to you for the poll.
That's right. Thank you very
Okay.
much, Tiffany. Sorry, I was busy answering the Q&A questions. A lot of there, so we do encourage you to ask these questions. Yeah, so the question in the poll is about the things we discussed just a few moments ago, so about connected information. And yeah, please do select all which apply here. So what information should be considered for connected information, whether that's the connection between the core content areas as an answer A, whether that should be a connection between the sustainability related disclosures and financial statements, and whether that's about risks and opportunities, the connection. So I don't see a poll on my screen. I hope you guys do.
We do see it, Robert. I'm sure Fiona
Okay.
will fix it for you momentarily, but just so you know, you have about 47% participation currently.
Oh, great. Okay, so I'll then let's stop the poll, and I'm sure. Yeah, great. Now I see it now. Yes, most of you answered it correctly. Indeed, the connection should be considered between all these elements. So A, B, and C. These are the right answers. You should select all three in order to meet the requirements of the ISB standards. You should consider connection between all these elements. And then moving further, we'll be now talking about materiality. So the standards are built on the concept of materiality as defined by the IFRS Foundation. We will go more into the detail later, but just to highlight it now, we'll be referring today to material information, which is information that if omitted, or misstated or obscured could reasonably be expected to affect investor decision. So just to signal for this at this time what materiality and what the definition of materiality is. On the next slide, we'll be then talking about additional guidance. So when developing the standards and during the ISSB consultation on exposure drafts, one of the key feedback topics was the importance of supporting preparers, particularly those with more limited resources in emerging markets. So to address this need and appetite of additional resources, um, in addition to the standards and application guidelines published in 2023, a number of educational resources were also published, and since then others have followed, including the IFRS Knowledge Hub, and also we are in the process of gathering examples and cases. The SASB standards were used to create the industry-based guidelines accompanying the S2, and the FSA credential was also updated with more plans to come. And also noting just for this training that IFRS Foundation Capacity Building Program launched at COP27 is a key part of our support to the preparers, and this training is one of the most important deliverables of this capacity build. So before we move on, let's now have another Zoom poll. This might be slightly a bit more tricky than the other ones. And because it's designed to really important to check your important principle in IFRS S1 and S2, how to disclose a topic where the IFRS has not yet issued a topic-specific standard. And in this case, we'll be talking about water. So the question is, so let's assume water is a vital input to your business. Currently there's no specific standards on water. What should you do? And you have four options here. Do not do anything about the water. Consult the other sources of guidance listed by ISSB, engage in consultancy, or copy competitors' reporting. And I'm seeing, almost half of you already took part in the Zoom poll, so I'm gonna finish it now. And you did answer correctly, most of you. Indeed, you should consult the other sources of guidance listed by ISSB to search for the specific metrics and targets related to this topic in order to disclose it as a relevant element in your sustainability reporting. Of course, engaging a consultancies might be also a good idea, and that could be done as well. But this you should firstly consult the other sources of guidance, and if necessary, also engage a consultancy. Copying a competitor's reporting, that's not an option, and similarly, doing anything should not be the case. So just to summarize here, even if the ISB has not issued topic-specific standards on the water, that doesn't mean that you should ignore the topic. Instead, the standards allow to use relevant sources of guidance, and for example, CDSB water guidance includes standards and frameworks to identify disclosure or material related risks and opportunities. Okay, so with this, we'll be handing over to Fiona, which will give a summary of the module 1.
Great. Thank you so much, Robert, for that. Fantastic. So let's wrap up now with a summary of this module and just take a few moments to review what we've covered in our first module together. So firstly, we reviewed the purpose of sustainability related disclosures. And a really key takeaway that we're hoping you'll leave this workshop with is that there are important benefits, both internally and externally, for collecting and disclosing sustainability related financial information. So ultimately, if you're not aiming to make good use of that information you're collecting to inform your own internal decision making and build your corporate strategy, then you're really missing an opportunity in this process. Additionally, if you have operations in hard to abate or high impact sectors, it could well be that your competitors are already disclosing and managing the risks that they face in that sector or potentially capitalizing on opportunities. And over time, that's going to leave your investors wondering why you're not disclosing similar information, why you're not taking advantage of those issues as well, or better managing them. So an important part of being transparent to your investors and communicating that journey you're on to manage your transition. And the next aspect that we looked at here was around the evolution of disclosure standards and the formation of the ISSB with that aim to simplify the reporting landscape. And so when you're thinking about other voluntary disclosures, you shouldn't necessarily see those as competing with the ISSB standards, but rather building on top of them using that building blocks approach that Tiffany and Robert just talked us through. And in our final section here, we introduced the IFRS S1, S2 standards themselves and some of the important concepts that you need to understand in order to use them correctly. And a key point I want to reiterate here from what Robert shared with us is that these standards and guidance are designed to meet the needs of investors. And so they're heavily focused on those prospects that we talked about at the very start of the unit relating to effects on a company's financial performance. Okay, so to wrap up our module completely, we're going to now do a quick Menti exercise again together, just to reflect on what we're thinking so far and also to help inform that disclosure plan that we'd like you to go away and develop as your homework assignment. And so what we think is an important aspect of your disclosure plan to get clear on upfront is the objectives of your sustainability disclosures. And so here we're thinking about being clear on what you're trying to achieve through your reporting. So, for example, if you're an organization that already has perhaps quite well developed sustainability disclosures and just needs to make some minor adjustments to align to the ISSB standards, your objective here may just be a case of alignment and repositioning. However, if you're in perhaps a newer starting position from this and you don't have those disclosures in place, you might need to set yourself a more significant goal here to really put in place the right practices and systems that you're going to need to inform your disclosures. So overall, we want you to have a little bit of think about where you're currently at in your organization, where you need to get to in order to achieve alignment with the IFRS standards. And so let's go into Menti together now. So I can see Landon's shared the link again. Thanks, Landon. And I'll share the screen again so that you can see other options too. Okay, I see we've already had some good responses in, so fantastic. So yeah, as we said, the question here is to let us know what your objectives are to achieve through your sustainability disclosures. So you might want to think about the stakeholder audience you're serving here, maybe the regulatory or other reporting requirements you need to meet, and what your overall degree of change is that you're needing from your current starting point. So people have mentioned giving stakeholders a clearer picture, providing that transparency to your investors, absolutely. And that's, of course, the key audience that these standards are focused on. So you're well aligned there with that objective. Someone's mentioned providing transparent, decision useful information, basically a good summary there as well. So developing your organization's image as a responsible and ethical business and getting an idea of potential future risks. So else do I see? Making industry aligned disclosures and making sure that sustainability issues will be taken into action. So yeah, that's of course nice to highlight as well that part of this is about reporting and that output, but that feedback loop of taking these issues back internally and driving implementation change, of course, is really key for capitalizing on those benefits. So we see investors mentioned a few times more here. Compliance with regulations, of course, several of you mentioned maybe you're in jurisdictions that have or in the process of mandating the use of the standards as well. I'm seeing some people kind of mentioning their personal goals, I think, from this training as well around enhancing their skills and building knowledge. Demonstrating commitment, helping to inform decision making. Fantastic, lots of good responses here. To showcase the business's long-term value creation. Yeah, so I think highlighting that long-term aspect here is a good point because often that is something that maybe it will need to change to adapt to these standards is that horizon that your organization is using to assess, identify, and disclose sustainability related issues. So perhaps expanding that horizon and linking those issues really into your value creation and business model indeed. Great. So some people have mentioned some specific issues that they maybe would want to focus on around circularity, climate risks. I'm seeing lots of good thoughts here. So risk management as well, I think is an important point to highlight. So really taking these issues back internally and thinking about how you can inform your organization's strategic resilience as a result of these disclosures is a really good point. Compliance is coming up a few times too. Fantastic. Thanks for sharing, everyone. I think you should be able to keep scrolling if you want to have a look at those objectives. But I think a lot of you are really capturing the spirit here of that balance we have between, complying and meeting stakeholder needs, with also really trying to aim to balance that with ensuring we're using this information internally for strategic decision making. So I think lots of good points that we would really encourage you to highlight here. And I think also what we really think is important as well is trying to be as forward-looking as you can in your approach here. So, of course, regulatory compliance in the near term may be front of mind, but as much as you can, aiming to build a strategy for your disclosures here that looks to the future and considers how you're going to use this information to inform your strategic resilience is a really good point to emphasize. Fantastic. So that wraps us up on our first module. So I'll reshare our slides and I'll pass you back to Robert, who'll get us started on module 2.
Great. Thank you, Fiona. Yes, we'll be now moving to module 2, align. So now that we have introduced the initial concepts, let's dive how to apply the SB standards, taking into account additional disclosures, including any relevant geographical or sectoral requirements, as well as peer practices and your leadership objectives. So let's have a look at the unit breakdown. So in order to understand how to ensure your disclosures meet global standards, we'll look at the two concepts in this unit. And first one is the global, and the main focus of this one will be the global baseline for sustainability-related financial disclosures for capital markets. And once we cover that, we will also discuss how additional disclosures fit. So let's begin talking about the global baseline. And to get started, we'll then first cover the first core content area, the governance. This aspect is centered on understanding how oversight of the sustainability-related issues is provided in the organization through the processes, controls, and procedures that have been put in place and at the board and management level. So how we're gonna cover this key content areas. So for each of them, we will discuss questions that you could ask in your organization to start identifying the information that will support some of the disclosure requirements. So, for example, as a part of the gap analysis. So if you look at governance specifically and the management requirements here, we can see that there are several that are fairly qualitative. And so the questions you might want to ask there would be, for example, which bodies are responsible for the oversight and management processes, controls, and procedures for sustainability-related and climate-related risk and opportunities? For example, is management responsibility delegated to a specific role or committee? Secondly, how and when do they get informed about sustainability-related risks and opportunities? How these issues inform strategy, decision-making, and risk management. So that would include the setting of targets to manage sustainability-related risk and opportunities, and further, whether this progress against these targets links to executive remuneration. So for the more information, you can make use of the SSE checklist tool, but remember, this is not a replacement for reading and using the full ISB standards. So we'll now have a couple of examples of these, of the real reports and what that mean in practice. And again, over to you, Tiffany, to present them.
Thanks, Robert. So let's look first at an example from Yara. So Yara is a global crop nutrition company. They're headquartered in Norway and they have 17,000 employees across 60 countries. And in this governance model example from their sustainability statement in 2024 of their integrated report, we see that Yara has a highly integrated model with responsibilities for sustainability embedded across relevant business functions, including risk management, health, safety, environment, and quality, HR, and also global climate and energy. So all those yellow boxes along the middle there. The board of directors and president and CEO are shown in the dark brown boxes around the top middle there. And the board audit and sustainability committee are on the far left. They assist the board of directors in overseeing the processes for and internal controls of sustainability reporting and material impacts, risks, and opportunities. The sustainability governance team have a direct reporting line to the CFO and are responsible for sustainability performance and reporting. The work is closely aligned, therefore, with the corporate performance and risk functions. Now, we also have here the Sustainability Network, which reviews Yara's accountability, the processes and systems in place for ESG policies, and also monitors sustainability performance. And the network is chaired by the Chief Compliance Officer. So we have a clear understanding in this diagram, what are all the kind of functions that we're talking about when we're discussing sustainability information and practices and processes. We also have arrows that are used to indicate the flow of information and input between different governance bodies in the organization. Now, just to note, there are multiple governance models to choose from, and the ISSB standards do not require a particular governance model. Your organization uses a governance structure that not only fits its purpose, but also suits the particular needs of your company and its legal environment. What we're showing here is how you might be able to share how that works and the information about that you might want to provide. Now let's show one more example that has a different structure here. So this one is Petronas. They're Malaysia's national oil and gas company and a global energy group with presence in over 100 countries. Now, in this example, the governance structure shows that executive, non-executive, and independent roles of the board of directors and the three committees to which the board delegates authority, responsibility, and operations. It explains all of those here. Note that climate-related matters are included in the responsibilities of all three board committees, and we can see that from this excerpt. The audit committee monitors climate-related reporting, and later in the report, we see that it provides assurance on the state of governance controls and compliance in relation to GHG emissions reporting. The Nomination and Remuneration Committee reviews the president and group CEO's performance scorecard, which includes climate-related measures. And also the Risk Committee's work includes climate-related risk and mitigations. Then if we look at the bottom of this image, you can see the executive leadership team's duties include sustainability, and they report to and assist the board. And this is an integrated structure like Yara, the last report we were looking at, and responsibility for climate and sustainability matters are embedded across multiple functions. They're not just sitting in one function. And that structure aims to provide role clarity and accountability, to promote strategic alignment across the group, and to facilitate decision-making at all levels. So with that, I'm going to pass back to Fiona, who's going to take us through the strategy component.
Fantastic. Thanks so much, Tiffany. So hopefully those examples there have helped us to get a little clearer on what the governance disclosures could look like. And now let's walk through our next core content area, strategy. So there are more disclosure requirements within strategy, but it's also really where companies can start to see the benefits from sustainability related opportunities and being better prepared for those risks. And so this content area focuses in on understanding what the company's strategy is for managing its sustainability related risks and opportunities. And within this, there's a number of high level areas that we focus on, which are considering what the risks and opportunities are, disclosing on the effects of those risks and opportunities, and then talking about strategic resilience. So let's review each of those now. So if we start with looking at the risks and opportunities, the IFRS S1 and S2 disclosure requirements here are all around helping users of general purpose financial reports to understand what the company's strategy is for managing sustainability related risks and opportunities. So if we look at the requirements relating to this, there are some questions that you might want to ask yourselves internally to get started here. So information is all around understanding what the risks are, what the effects of those risks might be, and over which time horizons those effects could be expected to occur. And this is where we need to keep in mind, as we talked about at the start of the session, that financial effects could occur before the risk or opportunity materializes. For example, if mitigations need to be invested in. They could also occur afterwards and they can change over time as well. So that's where the time horizons aspect can be quite interesting here. And on this list as well, some of these aspects are particularly relating to climate and align with the requirements for IFRS S2. So here, for examples, investors are wanting to understand the different types of risk or opportunity that organizations face in relation to climate change. This is where we often see organizations using the categories of the TCFD of physical and transition risks. And we'll talk a little bit more about the climate-specific aspects in a moment. But overall here, both S1 and S2 is including guidance to support companies to identify and disclose that material information about risks and opportunities. It's also recommended that companies use industry-based guidance and the SASB standards to further inform their approach here. But let's have a look firstly at another example here to help bring this to life. And so this example comes from Mondi Group's integrated report, and they are a multinational packaging and paper company operating across Europe, North Africa, and America. And in the left-hand side of the extract, we're just seeing a summary of the different types of risks and opportunities that the company has identified. And we see that they have connected those risks into their 4 key categories of strategy, finance, operational, and compliance. And then alongside this, on the right-hand side, we see a specific disclosure of the climate-related risks and opportunities that they expect to face. So we see a summary here of those different transition and physical risk types, as well as the opportunities as well. So just a simple summary list, which you're probably quite familiar with this format, but alongside these tables, Mondi also provide further detail to describe the nature and character of each of these risks and what the effect will be, which is helpful. And so another aspect of risks and opportunities identification that's important really brings us back to that point we discussed at the start of the session relating to time horizons. And so you might remember when we introduced the conversation about time horizons, we were saying that for sustainability related disclosures, this can be a little bit different to conventional reporting perhaps. So let's be clear on what we mean here. So the standards ask that you identify within what time horizon different effects of sustainability related risks and opportunities could reasonably be expected to occur. And how an organization defines what short, medium, and long-term time horizons are is going to vary between the company and will depend on a number of factors. So, for example, in defining those time horizons, organizations should consider what their investment and their business planning cycles are, what the strategic planning horizons are of their organization, perhaps the lifespan of the assets that they operate, and other factors as well. And so overall, what's important to keep in mind here is that the organization does need to define it for itself and put into its disclosures what time horizons it's using. So investors won't necessarily know what you mean by short and medium term unless you give them a clear quantitative definition of that. So moving on to the next group of disclosures in the strategy category. Firstly, we started there with disclosing what the risks and opportunities are, and then we move on to talking about what the effects of those risks and opportunities are on the business. And so the next set of disclosure requirements is all centered around providing that characteristics of understanding those effects. And so companies will want to start here by considering simply what the effects will be or could potentially be, considering there's likely to be some uncertainties there, and to think about where and when in the business those effects would be expected to occur. And that could include effects in the value chain outside of the company's direct operations. So looking at another example here, we'll look at the report of Global Chemical Producers BASF's report. And here they're illustrating really, this is a simple diagram, but I encourage you to look at the narrative detail that sits alongside this. Of course, we can only fit so much on a screen. But this diagram really summarizes how these different sustainability related issues that they've identified sit across and impact different areas of the organization's value chain. So within their upstream area of the organization, they talk about the processes that they're putting in place to procure more bio-based and renewable materials, to better manage supplier relationships, to mitigate sustainability related risks, and also to concentrate on sourcing renewable energy as well. In their own operational aspects, they're really focusing on their role in a chemical producing kind of context and how they can integrate measures to improve the efficiency and reduce emissions in their processes through investing in new technologies. And then finally, in their downstream activities, they talk about their efforts to streamline the portfolio of products that they're selling to their customers and to overall align towards products which are supporting sustainability related objectives with their customers. And I think what's useful to see here is that they illustrate really those effects across different areas of the value chain. And in the commentary that sits alongside this visual, they talk about how much revenue they're targeting to achieve from these sustainability opportunities in the future, and really how they're transitioning their business model to respond to these risks and overall be a more circular and sustainable company. Okay, so when we're talking about the effects of financial effects of sustainability related risks and opportunities, we know one aspect that can be quite challenging here is how to quantify financial risks. And that's an aspect that we hear mentioned often by organizations joining these sessions. So under the IFRS standards, a company is asked to disclose both quantitative and qualitative information about current and anticipated financial effects. However, there are criteria set out within the standards for when only qualitative information is required. So using only qualitative information is permitted if a company cannot separate the effects of a sustainability related risk or opportunity from other effects, or if there's a very high level of measurement uncertainty associated with that effect. And additionally, a final reason that would be allowable for providing qualitative information or a mix of qualitative and quantitative information would be if the company doesn't have the skills, capabilities, or resources to enable it to provide that quantitative information. Okay, so that moves us into the last part of the strategy component, which is all around resilience. And so we've looked already at identifying what the risks and opportunities are, disclosing the effects of those, and now we're thinking about overall what is the implication for these risks and opportunities on the company's long-term strategic resilience, and how prepared is it to build a strategy that is flexible to different plausible futures. And so this gets into the practices of scenario analysis, which you may have heard about. And so particularly companies are asked in the S2 standard to conduct climate-related scenario analysis and disclose overall what its assessment is of its climate resilience and how it's reached that assessment. So what are the inputs and the key assumptions that it's used to reach those conclusions? So we're going to dive deeper into scenario analysis a little bit later in the session when we look at the climate-specific aspects. But let's start by just thinking about some possible ways to approach this. So in this example from Stora Enso, which is a Finnish and Swedish forest product company, we see a couple of diagrams from their report which kind of summarize how they're thinking about their long-term strategic resilience. So they've identified a number of different growth areas in their business. Partially this is an opportunity, but also it's to offset the possible risks that they see from a decline in their traditional revenues associated with forests, pulp, and traditional wood products. And so while we don't have necessarily specific numbers here, we can already see a clear picture of where they're expecting to see growth in the long term. And again, in the narrative in the report, they provide some helpful disclosure here regarding the actions they're taking to reposition their business to capitalize on those opportunities and manage the risks better. And taking action now, for example, such as acquiring new businesses or investing in converting their machinery and R&D to capitalize on those growth opportunities. And a second quick example here comes from Marks and Spencer, which is a British retail company. And this is their disclosure about the impacts of climate-related risks and opportunities on their company's business, strategy, and financial planning. So I know there's probably a little bit too much information here for you to be able to read in detail, but we'll just pull out some of the key aspects. So firstly, they describe on the left-hand side what the risk or opportunity is. They then go into explaining the potential financial impacts of that risk or opportunity, and they connect through to their financial statements as well there where it's relevant to. They then talk about the different responses that they've put in place to manage those issues, and overall what the long-term and short-term targets are that they've set themselves to enable them to track how they're managing that issue, and kind of disclose their performance. So what we see here is quite a useful view of that long-term view they're taking to better respond to and evaluate how these risks are impacting their strategy. Okay, so now let's have another little poll to wrap up this section. So I'll launch the next question for you. And this just tests one of those concepts that we talked about a little bit earlier in this section, which is when is it possible for companies to disclose qualitative information or a mix of qualitative and quantitative information about financial effects? So if you might remember, I gave a couple of instances where that is an acceptable approach, and there may be possibly one here that isn't acceptable. So have a little think and let me know which of these you think would be acceptable reasons under the standards to disclose just quantitative information about a risk or opportunity. Okay, I'll give everyone a few more seconds to have a think about this. I see we've got about almost a third of you taking part so far, but it's great to get as many of you responding to these polls and thinking about the concepts we're talking about here as well. So let's give it a few more seconds, maybe 10 more seconds to see if we can get the response rate up a little bit. Although I think from the responses I see so far, I'm seeing a good consistent pattern at the moment of how you've responded. Okay, let's end the poll there and I'll share the results with you. So indeed, as most of you got correctly here, A and B are the correct options there. So as we covered, these are both criteria in the standards for when only qualitative information or a mix of quantitative and qualitative information is permitted. However, as most of you identified, option C isn't correct because, of course, it is important that our disclosures are balanced. And so if we do have quantitative information about potentially material negative financial effects, it's important that we provide transparency and we do disclose that information to our investors. And indeed, in those examples that we talked about in that section, we do see that there are examples here of the companies disclosing both negative and positive financial effects. Okay, so now I'll pass back to Tiffany to take us through some climate-specific aspects of strategy.
Great. Thanks so much, Fiona. So when disclosing information related to strategy, there are actually some additional requirements in IFRS S2 regarding climate in particular. So let's take a quick look at those. Great. So as we introduced earlier in the previous module, the disclosure requirements in IFRS S2 incorporated and built on the earlier TCFD, Task Force on Climate-Related Financial Disclosure recommendations. And here's a summary on this slide of some key aspects of the IFRS S2 in relation to strategy in particular, which Fiona was just talking you through. So IFRS S2 requires industry-based metrics and requires a company to refer to and consider the applicability of industry-based disclosure topics in the industry-based guidance in identifying climate-related risks and opportunities. Also, IFRS S2 requires disclosure of more detailed information around where the company's business model and value chain risks and opportunities are concentrated. Also, in describing the effects of climate-related risks and opportunities, the IFRS S2 does require disclosure about how a company has responded to, how they plan to respond to, and how they've identified these risks and opportunities. And the company is also required to disclose any transition plans it has and how the company plans to achieve its climate-related targets. Now, in providing disclosure about the current and anticipated effects of the risks and opportunities on a company's financial position, its financial performance, and its cash flows, the IFRS S2 also sets out criteria for when quantitative and qualitative information is required. And disclosure of only qualitative information is permitted under some circumstances. So similar to what we were just talking about, when a company cannot separately identify the effects of the risks and opportunities, or when the level of measurement uncertainty is too high. Also, when preparing disclosures on anticipated financial effects, IFRS S2 requires the company to use all reasonable and supportable information that is available at the reporting date without undue costs or effort, and requires the use of an approach that is commensurate with a company's circumstances. So that speaks a bit to one of the questions we saw in the Q&A about proportionality. So just keeping in mind that it really has to do with your company's current circumstances and your ability to answer these questions or evaluate these topics. Also, just to note that in using climate-related scenario analysis, which we were just looking at with Fiona, IFRS S2 requires the use of an approach that is also commensurate with the company's circumstances and consideration of all reasonable and supportable information. S2 does not specify the particular scenarios that a company would be required to use in a climate-related scenario analysis, but it does require additional information regarding resiliency on, for example, the significant areas of uncertainty considered by the company in its assessment, its capacity to adjust and adapt its strategy and business models over time, and details on how and when the climate-related scenario analysis was carried out. So just as a reminder, you can use the TCFD and IFRS S2 mapping document that we've linked to in our slides here to be able to compare exactly what additional information you might want to use if you're already using the TCFD recommendations. Now let's look at transition plans. So IFRS S2 requires you to disclose any climate-related transition plans that you may have, but there is no ISSB requirement to prepare a transition plan. This is simply if you are ready to disclose information about that. Let's briefly review maybe then what transition plans are, as well as some guidance points on how to develop a transition plan, drawing from the SSE's guidance on this topic. Now, transition plans are an aspect of the company's overall strategy that includes targets, actions, or resources for the transition toward a lower carbon economy, including, for example, GHG emissions reduction plans. So as an aspect of the company's overall strategy, you have to bear in mind that the transition plan must be aligned with the overall strategy then, including the business case and motivation for transition and the levers that the company strategy is most suited to using for its decarbonization plan. The transition plan should also be aligned with science, including what science says about requirements for net zero to be achieved and how carbon neutrality or Paris-aligned goals are explained in terms of the science. Now, the plan must include long-term transition goals supported by activities and targets to achieve these goals in the interim to monitor progress as you move forward. And given the uncertainty surrounding the transition, the plan should be transparent about dependencies for planned progress, success, and the risks and challenges of implementing the plan and how residual or unabated GHG emissions will be handled. The transition will proceed in different ways for different sectors. Therefore, a sector-specific pathway should inform the development of the company's transition plan. And we're going to take a look at some of the resources available at this in a moment. Before we move on, companies should consider how the transition plan will be evaluated by investors and others, and ensure that the plan has all the hallmarks of credibility. Now let's look at a few of those resources before we reach our break. So to get started on transition plans, there are already a number of resources that you might want to start looking at. To start with, just to note that in June, the IFRS Foundation published a new guidance called disclosing information about an entity's climate-related transition, including information about transition plans in accordance with the IFRS S2. And I think it does exactly what's on the tin. That title explains it well. This supports high quality, consistent reporting on climate transition plans, both mitigation and adaptation. And the guidance does not change IFRS S2 requirements, but it rather clarifies how entities should disclose information if they have transition plans. It does also leverage material from the Transition Plan Task Force, which the IFRS Foundation assumed responsibility for in 2024. And for further details on how to develop, implement, and disclose a credible transition plan, you can also use the SSE's model guidance on transition plans. We'll share that link shortly in the chat. And you can also find it on the SSE's website under its publications page. Some other resources, GFANZ, the Glasgow Financial Alliance for Net Zero, set out the expectations that companies can use to develop their own transition pathways. And also the Transition Plan Task Force disclosure framework provided additional guidance on the disclosure of transition pathways. This was launched in the UK in 2022 to bring together leaders from industry, academia, regulators, etc., to develop good practice for transition plan disclosure for finance and real economy companies. So with that, you have a plethora of resources to dive into. We don't expect you to do it right now, but we will give you time to maybe stand up, do a quick stretch, maybe get yourself a coffee and tea if you're able, maybe some water. And we'll return in 5 minutes when the lovely video music stops. So have a great break, everyone. Great. Welcome back, everyone. I hope you enjoyed that 5-minute break. Hopefully you got to at least stand up and do a quick stretch. And you're ready for the second half of the workshop today. So we're going to continue on with these core content areas, areas of information that you might want to disclose, and that you're required to disclose if you are aligning with the ISSB standards. Next, we're going to move on to risk management. So this category of disclosure focuses on enabling investors to understand a company's processes to identify, to assess, to prioritize, and also to monitor sustainability-related risks and opportunities. And this will include whether and how those processes are integrated into and inform the company's overall risk management processes. It also allows investors to assess the company's overall risk profile. So let's dig a bit deeper into this category by looking at some questions you might want to ask. Now, as a reminder, in the strategy content area, we were also talking about sustainability-related risks and opportunities with a focus on the risks and opportunities that could be reasonably expected to affect a company's prospects. Now, in the risk management disclosures, the focus now turns to how exactly a company identifies and assesses those risks and opportunities that are discussed in the strategy content area. So a company is required to disclose information about the processes and the related policies for risk management. So a firm might need to start asking questions internally about, for example, the inputs and the parameters for risk management and whether and how sustainability related risks and opportunities are prioritized. Also about how the nature and likelihood and magnitude of risks and opportunities are assessed. You can also start asking questions about how sustainability related risks and opportunities are monitored and whether and how processes have changed since the last reporting period. And beyond these, the standards also ask about the extent to which and how all of this has been integrated into the company's overall risk management process. So let's dive into an example. I think that always makes it a little bit more clear. This example comes from BMW's 2024 group report. Now, I'm sure you all know, but BMW is a car manufacturer. Here, BMW describes the process for risk management in words and in diagram. The company reports risk and opportunities for the current and subsequent financial year. Maybe let's turn now to this process that's summarized in the diagram that looks like a car wheel. So around the edges of the circle, we see appropriateness, which refers to the risk culture embedded in BMW's core values, and effectiveness, which is referring to the effective management of risks and opportunities that they say is the foundation of their business success. Note down the left-hand side, you can see the group compliance and internal control system for key interfaces to the risk management system. So the process is not the responsibility of the risk department alone. Risk management is steered by a centralized risk management function, although it is organized globally as a decentralized network with different network representatives. Now, the process itself involves early identification, analysis and evaluation of risks, appropriateness of risk management tools, including the measures taken, monitoring and assessment of measures taken, and finally, risk reporting. So all material risks are reviewed by the Risk Management Steering Committee, which is chaired by a group controlling, and many material risks are then reported to both the Board of Management and the Supervisory Board's Audit Committee. So just to note that these, again, are practices that this company has chosen. What we're not indicating is that these practices are what you should use, but rather this is how they're explaining it and how we can understand it, the information they're providing about it. Great. So let's go back to the climate aspect. So as with strategy in risk management, there are certain considerations in IFRS S2 that build on what IFRS S1 requires for risk management. And let's take a moment to look at that. So when disclosing using IFRS S2 for risk management on climate, There are some specific points to keep in mind. So, for example, you'll have to provide details on the inputs that are used to identify and assess risks, on scenario analysis used, and on any changes to the risk management processes. Also, S2 also requires on climate-related opportunities and the processes used to identify, assess, and prioritize these opportunities, which is more than we saw in the TCFD recommendations. Now, a part of identifying risks is really being aware of what risks and opportunities you should be evaluating to begin with. And the TCFD specify types of climate-related risks and opportunities, as well as examples of the financial effects they might lead to. So, example, transition risks and physical risks. So let's go over those briefly in case you're not aware of them. This can be a helpful kind of starting point as you get started in this. So transition risks arise from efforts to transition to a lower carbon economy and are often categorized as policy risks, legal risks, technological, market, and reputational risks. So these risks could carry financial implications for a company, for example, increased operating costs or even asset impairment due to climate-related regulations. And the company's financial performance could also be affected by shifting consumer demands and the development and deployment of new technologies, for example. Now, we also have here physical risks, and that includes risks from climate change that can be event driven. We often refer to those as acute physical risks, or from a longer term shift in climate patterns. And we usually refer to those as chronic physical risks. Now, acute physical risks arise from weather-related events such as storms, floods, drought, heat waves, etc., which are increasing in severity and also in frequency. Now, chronic physical risks arise from longer-term shifts, as we just said, in climate patterns, including changes in precipitation and temperature, which lead to sea level rises, reduced water availability, biodiversity loss, changes in soil productivity, etc. So these risks could carry financial implications for a company, such as costs resulting from direct damage of assets from those physical risks, or indirect effects of supply chain distribution from floods, for example, or increase in weather, severe weather events. The company's financial performance could also be affected by changes to resource availability, such as water, for example, or extreme temperature changes in employee health and safety. So those are just a few of the climate-related risks you can have in mind. But as we were talking about earlier, opportunities are really important as well and also required to be disclosed. So on the other hand, there are also climate-related opportunities which refer to potential positive effects for a company arising from the transition to a lower carbon economy. So, for example, efforts to mitigate and adapt to climate change can produce these opportunities, such as innovation in your operations or improving your processes, resource efficiency, or use of lower emission sources of energy, and supportive policy incentives, which might benefit your company. So if your company identified and disclosed a risk or opportunity, it might also benefit from a first mover advantage. And an investor could look at your sector and see your disclosure and wonder why your competitors have not identified it or sought to mitigate this particular risk or capitalize on this opportunity. And this could have then a positive financial impact or a reputational effect for you. So let's look at another example here. This is from RS Group, which is a UK-based distributor of electrical and industrial equipment with global operations again. Now, RS Group have analyzed their climate-related risks and opportunities for a number of years as part of their annual report disclosures. And the company identified 10 principal risks in their 2024 annual report, including climate-related transition and physical risks to their business. And this extract describes some of those physical risks in particular. Their most significant physical risk or physical climate risk relates to the impact of extreme heat on their distribution centers and the potential for extreme weather events to cause physical damage and disruption to their customer supply operations. The little red wheel icon that you see here shows that strategically and risk mainly affect operational excellence, and other icons show the stakeholder groups most affected by that risk. And in this example here, you can see the identified business owner, the metrics they are tracking internally to monitor each risk, and the actions they are taking to mitigate each risk. And the actions include building upgrades and associated capital investments related to that, and business continuity planning as well. Also, elsewhere in their disclosure, they provide further information on the projected financial impacts of the risks under different climate scenarios expressed in terms of impact on future annual operated earnings. So a lot of information provided here, but all helping investors better understand how this company is managing their climate-related risks. And with that, Robert, I'm going to pass back to you to go through metrics and targets.
Sorry. Perfect. Thank you very much, Tiffany, for this. Indeed, we'll be now moving to the next section of this module, and we'll spend some time on metrics and targets in more detail. So here, the disclosure are intended to enable investors to understand how the company is performing with respect to the sustainability-related risks and opportunities. So let's start with the metrics, and again, we will have some questions. So requirements on metrics are designed to enable investors to understand companies' performance in relation to its sustainability-related risks and opportunities. So preparers shall disclose information explaining how the targets are defined, if they are absolute or relative, if they have been validated by a third party, as well as methodology. For example, what is the method of calculation? What are the inputs? Are there any limitations, and what assumptions are involved? So that's about the metrics. And now moving to the targets. Requirements on targets are designed to enable investors to understand the targets company has set to monitor the progress towards achieving its strategic goals, as well as any targets it is required to meet for regulatory purposes. So disclosures for this element will then include whether these targets are qualitative or quantitative, and whether they are set voluntarily or by law or regulation. Of course, need to disclose the metric used to set the target and to monitor the progress towards its achievement. Another element will be then to define the baseline period from which progress is measured and the period to which the target applies. Then further, there should be you should disclose whether there are any milestones and interim targets defined, and if there have been any revision to a target, together with the explanation about those revisions. How that can work in practice. Again, we have now example. Over to you, Tiffany.
Great, thanks, Robert. These questions really distract you, don't you? Great. So let's look at an example from CLP, and thanks everyone for the questions. It keeps us on our toes. So this example, sorry, I'm going to go back one slide. Great. This example is one from CLP, which is one of the largest investor-owned power businesses in Asia Pacific, aiming to be a leading responsible power provider. Now, this example is from the 2024 sustainability report from CLP, and it shows waste management and material use metrics for 2024, including the percentage of pollution the company reduces through recycling and removing activities in line with its circular economy strategy principles. Now, the metrics are calculated in line with SASB and GRI frameworks, and the 2024 progress is compared with the 2021 baseline year, which set targets for 2025. So we can see how they're doing on those targets. And the target for waste products on the first row slightly exceeds actually their 2025 target because of a divestment, and important to explain where that progress came from. Now, we do have another example in the handout. So when you download the slides, you'll find a few additional examples in case that helps. But just to keep us on time here, we're going to continue on. And I believe I pass back to you, Robert.
Yes, great. Thank you, Tiffany. We'll be now moving to, again, to climate consideration for metrics and targets. So let's focus on these. So in relation to metrics, IFRS 2 requires a number of specific disclosures, including disclosure of industry-based metrics relevant to a company business, a model, and activities. Additional disclosures are required on greenhouse gas emissions, including separate disclosures for the consolidated accounting group and associated joint venture and information about companies' financed emissions. In addition, IFRS S2 also sets out a Scope 3 measurement framework to provide guidance for preparing Scope 3 greenhouse gas emission disclosures. While IFRS S2 does not explicitly require a company to disaggregate its greenhouse gas emissions disclosures by their constituent gases, IFRS S1 includes requirements on disaggregation that would result in the disclosure of the constituent gases being required if such disaggregation provides material information. I'd like to remind everyone if you can access more information on climate metrics in SSE's training tool on this topic. We'll share the link in the chat, and you can also find it on the SSE's website. So moving then again to climate-specific targets. There are some specific disclosure requirements here as well. So, for example, IFRS still requires disclosures about how the latest international agreement on climate change has informed the target and whether the target has been validated by a third party. Further, IFRS S2 also requires disclosures for more detailed information on greenhouse gas emission targets, including additional information and any planned use of the carbon credits to achieve a company's net greenhouse gas emissions targets. And finally, IFRS also includes additional requirements to disclose information about approach on setting and reviewing each target and how it monitors progress against each target, including whether the target was derived using a sectoral decarbonization approach. And now then focusing more on greenhouse gas emissions metrics as it comes a lot in questions. So let's then address them briefly here. So as probably to most of you, and a recap, but which one this whoever might be not familiar when then let's discuss the three scopes which are included in the disclosures. So scope 1 includes all direct emissions that occur from sources owned or controlled by the company, such as emissions from your company's facilities or vehicles. Scope 2 it will include emissions from generation of acquired and consumed electricity, steam, heat, and cooling, such as the electricity you purchase. And the scope 3 will be then all other indirect emissions that occur in the company's value chain. So in regards to the disclosure requirements here, the S2 requires company to disclose its absolute gross scope 1, 2, and 3 emissions in accordance with greenhouse gas protocol standards, unless a jurisdiction requires a company to use a different approach of measurement. If a company is using a different measurement method, there is a transition relief to use that method in the first year of applying the standard. Secondly, S2 requires a company to disclose whether and how the company is using an internal price on carbon for decision making. And thirdly, whether and how executive remuneration is linked to climate related considerations. And in May last year, the IFRS Foundation has published educational material in the format of Q&A detailing the greenhouse gas emissions disclosure requirements under S2. So please do refer to this material for further information. And then regarding the disclosure of the greenhouse gas metrics, we have another example. Over to you, Tiffany.
Thanks very much, Robert. So this example comes from Vale, which is a metals and mining company, and we're looking at their GHG inventory here. So maybe just a few things to note on all the figures we see here on the slide. So the tables on the left show GHG emissions broken down by scope 1, 2, and 3, as Robert was just explaining, as well as comparative figures going back to 2022 and to the baseline year from which GHG emission reduction targets were set. The circular diagram on the right side of this slide shows that GHG emissions have been broken down by source as well. So mobile combustion activities give rise to the most GHG emissions by source, followed by industrial processes. Notes and symbols throughout here are used to show us how the results have been prepared. And the inventory is prepared using GRI's GHG emission standard, GRI 301. Also, note 1 here says that the GHG emissions inventory has been assured by a third party. And note 2 explains that the GHG emissions have been reported on a gross basis before any type of compensation. So at the bottom of the page, there is also an overview of the company's long-term commitments on climate change and a report on their progress. So the baseline for scope 1 and 2 targets was set in 2017. And the aim was to reduce emissions by 33% by 2030 and to achieve zero net emissions by 2050. So by 2024, the company had made 81.5% of the progress toward its target. And the scope 3 baseline year was 2018. And the target is to be reduced by 15% by 2035. So by 2024, in this report, the company had made 88.3% progress toward its target. Now, with that example, let's come back to all of you and get some participation from the audience. So we want to ask you another poll question. What is the objective of metrics? Why are we disclosing this information? So is it to understand performance in, oh, we just got the slides moving. But the poll's still running, so keep using the poll. What is the objective of metrics? Great, thanks. Is it to understand performance in relation to an entity's sustainability-related risks and opportunities? Is it to understand progress towards any targets? Or is it to understand the company's assumptions for the future? Okay, let's give you just a moment. I'd like at least half of you to fill in the survey, and we're nearly there. Maybe we can get another 50 of you filling this in. Give you 3 more seconds to just hit go on all your answers. 1, 2, 3. Great, and that's half of you now. So I'm going to end the poll and share the results. Okay, so bravo, everyone. A and B are indeed correct. So targets are and associated metrics are there to give some insight into the performance of a company in relation to its sustainability-related risks and opportunities, and to understand its progress towards any targets that it's set. What is it aiming to do? It could give some insight into a company's assumptions, but let's remember that targets we set are not set in order to indicate where we think the world will be. It's where we can get to in the future. So it's not necessarily there to show the company's assumptions for the future. Great, so with that, that's the 4 core content areas. Now let's go into the second unit of this module. And here we're going to talk about the regulatory requirements and other additional disclosures that companies need to consider in this final unit. So let's remember back to when we were talking about ISSB being the baseline. So many companies already disclose against voluntary and mandatory reporting standards and based on their jurisdiction, stock exchange regulation, and industry norms. So these include things like local requirements. Both listed and non-listed companies must understand and comply with jurisdiction-specific disclosure requirements. And companies in your supply chain should also be prepared to provide necessary information upon request. Also, policy objectives, because companies should be familiar with policy objectives aimed at promoting sustainability. That's because governments may offer incentives like tax cuts or subsidies for sustainable practices. And they may also implement disincentives for activities that counter the national objectives. We also have industry standards. So companies may also need to provide additional disclosures to align with emerging industry practices and effectively manage sustainability-related risks and opportunities depending on their sector. And companies should also identify other stakeholders and their requirements through a materiality assessment to ensure comprehensive disclosure practices. But let's look at jurisdictions and the requirements that might be applied to your particular situation just for a moment. So national regulators are really actively considering how to incorporate the ISSB standards into their domestic frameworks, including decisions on timing and scope and alignment with existing reporting requirements. And as of the end of last year, as of December 2025, there were 39 jurisdictions that had adopted, used, or taking steps to introduce the ISSB standards into their legal or regulatory framework. Together, these jurisdictions actually account for around 60% of global GDP or over 40% of global market capitalization and 60% of global GHG emissions. So with this update, the foundation has released 17 jurisdictional profiles showing regulatory decisions and alignment with the ISSB standards, in addition to 16 jurisdictional snapshots providing updates on jurisdictions still consulting or designing their approach. So I highly recommend taking a look at those. You can follow that link in the slide deck to find out maybe what's happening in your country. This also marks a significant milestone in achieving a global baseline for sustainability disclosures. These profiles provide transparency and reduce uncertainty for investors, companies, and regulators. They support interoperability agenda. They ensure jurisdictions can build on the ISSB global baseline. They help capital markets access consistent, comparable, and reliable sustainability information. These profiles complement the May 2024 jurisdictional guide and are developed through bilateral engagement and independent review. Also to note, the IFRS Foundation will continue supporting jurisdictions via consultations, the regulatory implementation program, and also the roadmap development tool with links to each of these in the slide if you want to learn more about that. Now, also to note strategic relationships that support interoperability. So on voluntary reporting standards, the IFRS is actively supporting jurisdictions and non-jurisdictional stakeholders to ensure that the ISSB global baseline meets investors' needs and has good interoperability. So this reduces the duplication and improves the efficiency of the reporting system as a whole. Many of the decisions taken to develop the ISSB standards have helped advance interoperability. So for example, using the TCFD architecture as the basis for their standards facilitated interoperability with existing disclosure requirements. Also to note that CDP is ISSB's key global climate disclosure partner. And from 2024, the CDP questionnaire has been aligned with IFRS S2. So in addition, the IFRS Foundation is working closely with GHG Protocol and GRI and others to make sure that it's very easy to use all of these frameworks and standards together. Let's look specifically at a few of these. Let's start with GRI. So IFRS and GRI, the Global Reporting Initiative, are looking to ensure the maximum interoperability possible between their standards, again, to facilitate efficient and effective reporting by companies around the world. So in June 2025, the GRI Global Reporting or Global Sustainability Standards Board, or the GSSB, granted equivalence to IFRS S2 climate-related disclosures for Scope 1, 2, and 3 GHG emissions under their GRI 102 standard. And to be able to use the equivalent IFRS S2 GHG emission disclosures, organizations reporting in accordance with or with reference to the GRI standards will have to first measure their greenhouse gas emissions in accordance with the Greenhouse Gas Protocol, a corporate accounting and reporting standard from 2004, and include a reference to the location where the information for each of the disclosures can be found as per the published GRI content index requirement in GRI 1, their foundations from 2021. Let's also look at the European standards, so the ESRS. So the IFRS and EFRAG, which develops the ESRS, have also been working closely to support interoperability between these standards. So many companies are expected to choose or be required to apply both ESRS and ISSB standards. And as jurisdictions around the world introduce the ISSB standards as a global baseline, companies will be better prepared than to meet disclosure requirements around the world. This high degree of alignment between ISSB standards and ESRS really reduce complexity and duplication for companies applying both of these standards. ISSB standards facilitate decision-useful information targeted at capital markets, enabling global comparison for investors. Now, a joint guidance published by IFRS and EFRAG provide practical support that explains how companies can effectively comply with both of these standards. And similar to what we we're talking about with TCFD, it really maps the two requirements. So it makes it very easy for those who are using both to understand any differences there. Now, finally, let's also look at integrated reporting. So the integrated reporting framework provides a principles-based guidance for reporting structure and content. And when used together with the ISSB standards, including as a source of guidance, as recommended by the IFRS Foundation, the integrated reporting framework can support a holistic view of the value creation process through governance and business model disclosure to drive connectivity between financial statements and sustainability-related financial disclosures. So as such, it supports high-quality corporate reporting. And when it is underpinned by integrated thinking, so not just disclosing, but thinking connected here, it can enhance the quality of a company's corporate disclosure. So you'll also find guidance. Anyone who's been using integrated reporting, you can find guidance there. Also, we have a hidden slide. So when you download the slide deck, you'll get an extra slide there on how to apply integrated reporting. Now, I'm coming back to all of you in the audience. I want to ask you another question. So, why your disclosure objectives should consider what? We've just talked about all these different frameworks that you might be using. So, when you're setting your objectives, what should you be considering? The ISSB standards only, maybe the ISSB standards and regulatory requirements. Should you just consider regulatory requirements? Or should you be considering the ISSB standards, regulatory requirements, and other sources of guidance? Now, I don't think I'm going to leave this too long because clearly you all know this very well. So yes, in the chat too, I'm going to share it, and applauds to everyone. Congratulations, it's D, correct. So the ISSB standard, regulatory requirements, and other sources of guidance. So it's important, of course, to make sure that you consider all of these inputs when developing your organization's disclosure objectives to ensure really a holistic approach that meets all relevant requirements and stakeholder expectations. Now that brings us to the end of this module. I know it was a hefty one, but let's review, and I'm going to pass over to Fiona, who's going to take us through the module summary.
Great, thanks so much for that, Tiffany. So we're going to wrap up this module again with a few key takeaways and a little bit of an exercise in Menti. But firstly, to start with those key takeaways. So we reviewed all of those 4 core content areas of the ISSB standards. So that's governance, strategy, risk management, and metrics and targets. But an important thing we'd like you to remember here is that, of course, these don't operate in silos. And we saw in our disclosure examples that despite those being four separate categories of disclosure, of course, within an organization, these are all very much interconnected. And we also discussed how your disclosure requirements might go beyond S1 and S2. For example, to meet different stakeholder needs, to meet regulatory requirements in certain jurisdictions, or perhaps to meet industry standards as well. What's important to remember if you're going to be doing this and adding additional disclosures is that the ISSB standards have been purposely developed to act as a baseline. And so then that building blocks approach allows you to build on top of those and add additional disclosures for different reasons. However, the tricky balance to strike here is that if you're going to add those additional disclosures, you do also need to be careful that you're not obscuring the requirements of S1 and S2 and in making sure that those are still easy for your investors to access and find. Okay, so to wrap us up, let's go back and do a little bit of an exercise. So we'll go to Menti in a second, but I'll just explain a little bit first what we'd like you to think about. So we've just talked you through all of the content areas there, and you're probably thinking to yourself, some of these things I already have in place. There's definitely some gaps that I need to think about here. And so, of course, what we'd really recommend that you go away and do after today's training session is conduct a thorough gap analysis to understand where you're at currently and perhaps what gaps you have to address. And so there's a homework, in our homework, there's a simplified checklist that you can use to support you with this. And there's a more detailed checklist available in the SSE Disclosures Toolkit, which you can find in the slides as well. But overall, what we think is important to do here is to get a clear understanding of what your gaps are. And so there could be different types of gaps, of course. You might have particular enhancements or additions that you need to make to your reports, maybe on new topics, or maybe to put in place certain practices or processes to build your control environment. You might also have gaps in terms of your internal capabilities. So maybe you need to think about resourcing and upskilling as well. So, of course, there'll be many different issues that you could consider here, and we don't expect you to be able to identify all of these now or indeed to have addressed them yet, but helpful perhaps just to take a pause and reflect based on what you've heard so far. What's front of mind for you, maybe as some of the key gaps that you might need to tackle for your organizations? Perfect. I see we already have some responses here. So we'll have a look at those while everyone else is having a think. But the question is basically, yes, any key gaps that you've identified, either in your disclosures or your processes. And I think hopefully it's helpful to see there's actually a lot of organizations who probably are in a similar position to you. If we look at these gaps, or maybe others have thought of gaps that you might have too, but maybe you've not identified yet. So hopefully this can be helpful. So I've seen Scope 3 reporting being mentioned, and another mention here of alignment between financial disclosures and GHG disclosures. So indeed, another person here mentioning the practical development for nations of carbon sinks, I think, and that's an interesting topic to highlight. But perhaps the general point as well being that, using your GHG disclosures to demonstrate your alignment with national policy objectives too. So someone else has also mentioned risk management practices. So maybe thinking more about your internal processes there and how you can embed the sustainability risks and opportunities that you're identifying and disclosing into those internal practices. Quantification is coming up again. Of course, we talked earlier in the session about how we know quantification can be a particularly challenging aspect. So, of course, that's very natural. The starting point here is really just to understand what data you have available, working closely between your colleagues in sustainability and finance to try to adopt, robust approaches to financial quantification, drawing from your experiences of financial accounting. So people are also mentioning integration into ERM for sustainability. We know a common issue there is that time horizons piece again. So indeed, your enterprise risk management process is likely to be a very well structured framework to use for sustainability issues, Often it's geared up to look over quite a short-term horizon relative to sustainability issues. And so that's where engaging with your colleagues in risk to explore how a wider time horizon could perhaps be built into that process will be quite important here to make sure you're capturing those medium and longer term issues. Great. So I see mentioning about targets and setting scientifically aligned targets as well. Of course, as we've talked about, the requirement here is to disclose those targets that you have, but of course, setting targets will be a helpful tool to provide clarity on your performance against different objectives. Also to just demonstrate, how you're embedding the different issues you've identified into your kind of strategic objectives as an organization. So we're seeing mention here of a risk identification as well. A few people I think I see mentioning governance. So maybe you need to more clearly articulate within your governance structures where responsibilities lie for sustainability issues. And as we talked about at the start of the session, when we talked about governance, of course, many different models exist here, and it really will depend on the company. I think what's most important is just that you have a clear articulation of your governance arrangements. That may well be something that evolves over time as your strategy evolves, but getting clear with your colleagues up front how you're approaching this, maybe forming, interim measures that you can agree a set periodicity to evaluate could be important as well. Okay, so seeing allocation of resources as well being mentioned. Indeed, I think often in the world of voluntary sustainability reporting, it might have been the responsibility of one individual to manage reporting. They may have even been juggling that alongside implementation of strategy as well. But clearly, what we're seeing here as we move towards mandatory standards is we need to be thinking about sustainability accounting on a similar basis to a financial accounting in terms of the team, the skill sets, and the controls that we have in place. So definitely considering those resource implications and how you can secure the budget to respond to this ahead of time is an important thing to put in place. Okay, let's see. So I'm seeing someone mentioning the need to benchmark against the different frameworks and develop a roadmap. That sounds like a very good approach indeed. So, thinking, as you say, in a coherent way about your different sustainability requirements. Hopefully, some of those mapping documents that have been shared can support you in conducting that assessment of alignment. And I think, as that person mentioned there, it's about prioritization. So, of course, it's natural that there will be gaps at the early points in this process, but what we need to think about is how to prioritize addressing those gaps, making sure that we have the key foundations in place that are part of the mandatory reporting requirements to inform our first disclosures, but then thinking about how we can also evolve our reporting practices over time and continue to update and improve practices. That's where the disclosure plan that we're talking to you about across the session today can be a really helpful structure to provide that transparency about how you're addressing these gaps and having a structured approach to addressing them. Fantastic. There's so many good answers here. We could keep talking about these for a long time, but I'll just have a little scroll and see if anything jumps out to me that we didn't already discuss. Maybe someone's mentioning sector-specific issues as well. So I think we've talked as well about the use of industry guidance and the SASB standards here to inform your approach to disclosing on particular sectoral needs as well. So do ensure to look at those additional sources, which you can find on the IFRS Knowledge Hub to support you there. Fantastic. So, but I think scope 3 and data being mentioned very often here. And of course, that is quite a common challenge. A lot of this really is about mapping out what you already have and using that data. So we're going to explore that actually in our third Menti exercise. So we'll leave that discussion to build on a little bit later in the session. But great to have got your initial thoughts and get you thinking about what some of those gaps may be. It looks like lots of you already have a good sense of where your efforts may need to be concentrated there. Okay, so this is bringing us now into our third of 4 modules. So I'm going to pass you back to Tiffany to get us started on module 3.
Great. Thanks so much, Fiona. Just going to exit out of the Q&A here. Great. So now that we have outlined the detailed content requirements for disclosure, I think we should look a bit more practically at how that is done. Starting with the practices and processes needed to collect the appropriate data for disclosure. So in this unit, we will cover 3 topics that are key to collecting sustainability related information. And as I mentioned, this unit will cover in more detail kind of the how aspect, and hopefully that hits the nail on the head of a lot of the questions we've been receiving. So to kick us off in this unit, let's first look at how to identify sustainability related risks and opportunities. So IFRS S1 asks companies to provide material information on all sustainability related risks and opportunities that could reasonably be expected to affect a company's prospects. And IFRS S2 set out the requirements for climate related disclosures. So what about risks and opportunities beyond climate? S1 directs companies to sources of guidance to support the identification of risks and opportunities and information to disclose about them. First, when identifying which risks, sustainability related risks and opportunities to report on beyond those in climate. S1 says that consideration must be given to the SASB standards. In addition, companies may consider other sources of guidance, including industry practice and materials of other investor-focused standards. And for those of you who aren't familiar with SASB standards, they do identify kind of material risks and opportunities that you might want to consider in your particular industry. So then after a company has identified which sustainability related risks and opportunities to provide information about, S1 supports companies in identifying then the material information. So what information to disclose. So here S1 says, again, a company must consider the SASB standards, and companies may also refer to other sources, including GRI standards and the IFRS, the European Sustainability Standards or Reporting Standards. This process of identifying sustainability related risks and opportunities and the information to disclose about them is covered in great detail in the educational material published by IFRS Foundation in November 2024. And that publication is called Sustainability Related Risks and Opportunities and the Disclosure of Material Information. So I highly recommend making use of that. Today, we're going to go through an example to see what one company is doing. So this is Ayala. It's a Philippine-based corporation. It's a conglomerate including property development and various diversified industries such as banks, healthcare, technology, etc. And this extract shows the process that Ayala uses for identifying risks to its business. The process was updated in 2024 by this company, and it learns from previous years, taking into account of the business environment and the need for a more forward-looking approach to risk management. So in Ayala's case, the first step is to establish the context with which the business operates, including looking at sources of risk intelligence from global risk reports, subject matter experts, and the management team. And this helps the company understand emerging risks and trends and kind of prevents blind spots. Then material sustainability topics that have been identified are integrated into the analysis to ensure that environmental, social, and governance factors are considered alongside traditional business risks. Also note that Ayala's statement that by embedding ESG considerations into its risk framework, Ayala has strengthened its ability to anticipate and respond to emerging sustainability risks while also identifying opportunities for long-term value creation. So I think they really highlight really well here why they're considering these sustainability factors and why they're embedding that in their kind of mainstream risk management practices. Let's look at one more example here. This one is from Nestle. Oh, no, it's not. Sorry, Nest. And this is an extract from Nest 2024 annual report. So those who don't know Nest, it's a company based in Finland, and it's a leading producer of sustainable aviation fuel, renewable diesel and feedstock solutions, particularly for the chemical industry. And it uses science and technology in order to really transform waste and other resources into renewable fuels and circular raw materials. So this extract comes from the climate section of their annual report. It shows how the company identifies both risks and opportunities in two different scenarios and over a time horizon until 2050. The effects of the first scenario, which is the net zero world by 2050, are considered on a global basis and for the EU and North America. And they do this because some economies may take action at a faster pace than others. In both cases, the company anticipates opportunities from growing demand for renewable and circular solutions. And on a global basis, they can expand into new markets and sectors. So in the EU and US, they expect their supply of renewable and circular solutions to be supported by regulation and also voluntary ambitions. And they identify risks too associated with competition and acceleration of new technologies. In the compromised climate target scenario, climate action is slow and global warming of 2.5 to 3 degrees is expected. So in this scenario, the company can differentiate itself from others by providing renewable and circular solutions. And the risks they see here is that demand for those products won't be as high as in the other scenario. Now, in all the scenarios they looked at, the company provides detail of the indicative financial impact that they expect if those particular scenarios were to play out. And this extract shows an overall assessment of whether the scenario is positive or otherwise for the company and to the indicative financial effect because of their business model, which is focused on development of renewable fuels and circular products. The greatest opportunities for this company actually arise in the lowest temperature scenario, which depends on really a rapid and radical temperature reduction seen. Great. So now let's look a little bit at proportionality mechanisms. Now we've had quite a few questions about this also in the chat. So hopefully this clears a few of those questions up. So just to note that despite everything, identifying risks and opportunities can indeed be a challenging exercise, but it's certainly valuable and something that everyone needs to start on if they haven't already. But to make sure that the effort is proportional to the benefits, especially as you're getting started and this might be new, the ISSB standards specify that in applying specific requirements, companies shall use all information that's available at the reporting date without undue cost or effort to disclose sustainability related financial information. So keeping in mind, if you are able to access this information or collect this information without, as they say, undue cost or effort, so really going, way above and beyond trying to get this information. So if you have to, hire a team of 20 people in order to report certain disclosures, maybe you look back at the proportionality principle here. At the same time, companies are required to use all reasonable and supportable information when assessing and disclosing risks and opportunities. And this means that the information the company uses for assessing its risks and opportunities shall be specific to that company. And this is important to understand impacts on the actual company rather than in general, right? We want to understand how these risks and opportunities play out for your particular company, not for, for example, the whole industry. At the same time, the company shall understand how it might be impacted by external factors. So in some cases, reasonable and supportable information includes information about past events, about current conditions, about forecasts, and this can help identify trends and potential developments that the company should prepare for. Just to note before we move on, the ISSB standards also require preparers to use an approach that is commensurate with skills, capabilities, and resources when applying these requirements. So that will, of course, gradually increase with time. So maybe you're very new at this now and learning how to do it, get started. And as you build up those skills and capabilities and resources, you'll be providing more and more information. And with that, I'm going to pass over to my colleague Fiona to take us through the next part of this module.
Lovely, thank you, Tiffany. Okay, so as we say, we're now moving from that identification step of risks and opportunities to how we go about evaluating them. And this is where we need to come back to thinking about the financial effects of our risks and opportunities as well. And we know that can be a daunting aspect. And I think many of you highlighted in that gap analysis exercise there that evaluating the financial impact was a key consideration. So let's have a little bit more of a look at this together. And so this is where I think also we want to get into the process of resilience and scenario analysis to help us conduct that assessment, particularly when we're talking about climate-related risks under S2. For this disclosure requirement, companies are asked to disclose information about the implications of climate change for its strategy and business model. Overall, companies are asked to consider their financial and operational capacity to adjust or adapt their businesses over the short, medium, and long term. And so, for example, you might want to test your company's resilience against a new regulation to limit certain high emission activities. And so to do this, you'll need to use climate scenarios drawing on science and analyze how these scenarios will lead to effects being occurred for the company. And what's important to remember when we're starting out with scenario analysis is that it's not asking you to predict the future or to forecast what's going to happen. It's simply a tool to help you to test what could plausibly happen. So different pathways that you could potentially see occurring. And then this is going to allow you to build a strategy that's more resilient and adaptable to those possible different futures. So S2 doesn't specify which scenarios a company should use because ultimately the selection of scenarios is highly dependent on your sector, the time horizons you're using, the particular type of risk or opportunity you're looking to assess, for example, physical risk or transition risk, and the location. However, companies are asked to use relevant scenarios and to provide disclosures explaining which they've selected, what assumptions they've used, and what conclusions they've drawn from this assessment. And again, this is an area where proportionality is considered. So companies are asked to use an approach that's commensurate with their circumstances and to use all of the reasonable and supportable information that's available to them without undue cost or effort. So let's have a look at a couple of examples as we move through this section to help us understand how this works in practice. So the example we're seeing here is Nestle now. We had Neste and now we got Nestle. And this is a Swiss multinational food and drinks company. And we can see here one output from their disclosure on their climate scenario analysis. And this is a summary of their assessment of how they might expect the yields of some of their key agricultural commodities to change under a different climate in the future. So here we're looking at a medium emissions scenario out to 2040. And overall, they're showing that there's a mixed picture across the world, whether they would expect crop yields to increase or decrease for certain commodities. And they talk in the narrative alongside this about the different types of climate hazard that they've considered here, including heat waves, drought, and water stress. But overall, they talk in the report about the fact that they do expect to see more volatility in the availability and the cost of some of these commodities. And so alongside this, they talk about the measures they're taking to adapt to this. So for example, looking at innovation in crop varieties and products, investing in R&D into more resilient crops, and also engaging in politics and advocacy to help raise these challenges. And of course, we've seen that in one example, but we know that when we're anticipating the possible materiality of future events, this can be very challenging. And so to help us with this determination, IFRS S1 sets out a number of issues that companies are asked to consider. And you're asked to continue to evaluate these uncertainties at each reporting period, so that you're continuing to evaluate them as your understanding of these issues develops. And so companies are asked to consider here thinking about both low probability and high impact outcomes, thinking about all pertinent information that they can use to inform this assessment, and thinking about risks both individually and in the aggregate sense. And so, as we've said, companies aren't asked to necessarily repeat scenario analysis every year, but they are asked to continue to evaluate these scenarios and the uncertainties associated with them. So scenario analysis can be integrated into your company's strategic planning processes and timeframes. But each reporting period, you just want to come back and assess the quality and uncertainty associated with that information. Okay, back to you, Tiffany, for the integrate segment.
Great. Thanks, Fiona. Okay, so after identification and evaluation, the third concept we want to discuss in this unit is integrate. And I'm going to move us straight through to the next slide here. There we go. Great. So some companies might already have processes for collecting the content described in the last module. For example, a company might already have processes for the disclosure of corporate governance information or the disclosure of risk management processes. And in those cases, the company can adjust those processes to integrate sustainability related risks and opportunities. In other cases, the company might need to develop new processes and plan for its integration into the company's processes over time. So some considerations to take into account when doing this is to start with a clear understanding of what processes need to be adjusted versus those that need to be created from scratch. This might sound obvious, but because, as we discussed at the beginning, these processes can often stretch across the organization, there might already be a process in place, maybe even in another team, that can be adapted. Then when assessing if an existing process can be adapted to consider sustainability related issues, it's also important to assess its suitability and whether new prioritization criteria or controls or contributors are needed. Another important aspect to consider is resources that are in place that may need to be added. So we do suggest getting started with a disclosure plan. It's a great way to integrate sustainability related risks and opportunities into an organization's practices and processes, and it can help the company answer a number of important questions such as what are the company's reporting goals and objectives, or how will those individuals and departments be organized, and what will they be responsible for? What about assurance? And importantly, what are the sign-offs and the procedures? So getting a plan in place can really help you to kind of get your house in order before moving on. So you can use these slides to move forward on that. I'm just going to go through a quick example here with you. And this example is from Danish pharmaceutical company Novo Nordisk. And it illustrates the basis on which the company is reporting. Why are they reporting this information, and how have they decided what to include? So it outlines here regulations, standards, and practices that the company has to or has chosen to use for its disclosure. And the company explains the approach and scope used for data collection and verification for its reports. It also includes, for example, time horizons considered for preparing, and how estimates have been used and where to find more information, etc. I think agreeing all of this, the objective of your reporting before getting started to collect data is really essential, so that the right information is being collected and there's no surprises at the end of missing information or not being able to fulfill any of these requirements. So imagine having to go back to collect some information again when a lot of you know that a lot of this information, takes some time to build up and implement. So that disclosure plan is not a requirement, but it's something that we really recommend doing to get kind of your house in order. So let's do a couple quick polls here. Let's start with this poll number 9. Is a disclosure plan required by the IFRS sustainability disclosures? I might have just let that one go. Maybe you heard it, maybe you didn't, but let's see if any of you get it. Is it required? Yes, you must disclose your plan, or no, but it's a very helpful tool. A few of you were not listening very well because you did not hear that I just said this out loud. I'm just going to give you maybe 3 more seconds to fill that out. We're really at 50-50, so there's no clear answer in the poll right now. Well, the right answer is slowly nudging forward. So I'm going to end the poll now, share the results. 50-50. I'm not speaking clearly enough, I guess. No, it is not required. Those in the chat saying B, yes, it's not required. Similar to a lot of the practices we're discussing, the practices themselves are not required. It's the information you're providing, which is required. No, it's not required to do a disclosure plan, but we do highly recommend it, and it helps to make sure that you're prepared as you move forward. Now let's do one more Zoom poll. Why would you do a disclosure plan then if it's not required? And sorry, we closed it early on you, Michelle, but good job, you got it right. So this question asks you why then. So a disclosure plan can help a company to take control of its narrative, support collaboration, act as a reference point and audit trail for disclosure, or it can help you to skip full disclosure. If you have a plan, you can just skip the rest. Is that true? Luckily, none of you are really picking that. So I'm going to clearly you all know the answers to this. Well done. So no, you cannot skip full disclosure by having a plan, but you can ensure that you do proper disclosure. And as we see here, it will help as an audit trail. It'll support collaboration and knowledge sharing, help you to work together with the whole organization, and it will help you to take control of the narrative with general purpose financial reports. So well done, everyone, with that. And that's the end of module 3. And I'm going to pass back to Fiona to summarize what we learned in this module. Thanks, Fiona.
Lovely. Thank you so much for that, Tiffany. So we're wrapping up module 3 of 4 now. So well done, everyone. We're through a lot of the content, and it's been hopefully useful up to this point to share this with you. Just wrapping up on a few of our key takeaways from module 3. So let's come back to connections. In the last module, we talked about highlighting the importance of connections between those 4 core content areas of disclosure. And then here in this module, we've learned that, of course, there are many connections between a company and its external and internal environment as well. And really, these connections are what we need to focus on when we're identifying key risks and opportunities. And then the second thing we talked about in this module was relating to evaluating those risks and opportunities. And a key component of that evaluation is consistency in your assumptions. So we talked about scenario analysis, and that can be a helpful tool and indeed a requirement for S2 to conduct a climate-related resilience assessment using scenario analysis and disclose the outputs. But what's really important here is that we're keeping track of the assumptions that we make in this assessment and that we're providing transparency in our disclosures as to what those assumptions are. And then finally, as we saw in our third unit there, even if some of this data may not be data that we're already disclosing, it may well be that you're already collecting it internally for different reasons. Or perhaps it's the case that you do have practices or processes that you could use to collect that information. So maybe what we want to try and do here is just to try and build on and use those processes as much as we can and not start from scratch. So working with what we already have in terms of data. And with that point in mind, that's what brings us into our third Menti exercise to round up this section. So what we'd like to take a moment to think about here is how we go about addressing those gaps that we've identified. So many of you highlighted, of course, that data collection, particular topics of data like carbon metrics were where some of your key challenges would lie here. And so what we'd like to think about now is how you could go about addressing some of these data collection gaps. So you could think here about what sources of information would be available to support you in getting this data, maybe what systems or processes you have or you could implement to help you find or collate this information, and how you can connect those in overall to what your company is already doing in terms of financial accounting as well. So let's take a moment to think about that together in Menti. And our next question asks exactly that. So what are the existing processes and systems that you might have in place in your organizations that could allow you to collect data on sustainability related risks or opportunities? So feel free to share whatever comes to mind here. It might be a particular system, it might be a particular data source, but I think it's always a useful exercise to realize that actually we do have more to work with perhaps than we might think here. And there are many sources. So please do share, and I'm sure your insights will be really valuable to other participants as well. So thank you for those who've already shared here already. So someone has mentioned about building management systems. Definitely very relevant when we're talking about environmental performance information for sure. A lot of that will be captured in those systems and can be hopefully integrated into your reporting processes. So someone has mentioned maybe developing data collection templates to relevant owners of data, which pertain to them to avoid duplication and errors. Yeah, so making sure that the right person is receiving that data request in the organization, and also having a clear audit trail, I guess, of who's provided that information as well, and what the source is. So data collection. Someone's mentioned here about using existing assumptions. So yeah, making sure you're clear on any assumptions that you already have, and that you have a structured approach to capturing and recording those assumptions and continuing to update them. I know I've been in the shoes as a sustainability reporting professional of receiving someone's spreadsheet from last year that's impossible to understand how they've got to where they've got to. So having good controls and structures in place to make sure you're capturing how you've arrived at your figures will ensure that you've got consistency and repeatability in those methods as well. So we're seeing mentions here of using your kind of quarterly and annual reporting, maybe financial data sources. Yeah, exactly. You know, a lot of that financial and operational strategic information is very interconnected, of course, with sustainability risks and opportunities. Maybe it's been collected with a slightly different lens in mind, but indeed it's likely to be very relevant inputs to this assessment and disclosure. Someone's mentioning that maybe their ERP system doesn't support the collection of the required data. Whereas I see some people saying maybe they could use it. So that's an interesting thing to understand within your organization, and maybe engaging with your colleagues who manage those systems to explore, you know, are there possibilities to adapt that, add different reporting requirements within a new software system, within the existing software system could be a good starting point indeed. And if not, at least identifying that is a limitation, and then you'll need to maybe explore whether you do need additional software to support you. Some people are mentioning supply chain and procurement information. Yes, definitely a very good point to highlight, because, of course, those assessments that you suppliers are asked to do as part of due diligence processes or pre-qualification requirements will give you lots of really interesting insights into how they're approaching these issues and what controls they have in place. So, indeed, a very important source of information about value chain risks and opportunities in particular. Brilliant. I see lots of very useful sources here. So I'll leave this question available to you to have a look at in the background so you can see those. But I think hopefully what's clear here, the message that we're conveying from all of these responses, that indeed there's a lot out there. So probably the starting point we'd encourage you here is just to really map out with your colleagues what these sources of data are, what you already have, and maybe what you might need to build and adapt processes to allow you to collect. And as well within the IFRS standards, you know, there is a kind of hierarchy here where, of course, if you can get primary data, then that's great. But particularly when we're talking about our value chain, we know that can be challenging. And so there's a hierarchy in place for sources of estimation and approximation that you could use where perhaps actual data can be quite challenging to obtain. Okay, brilliant. Thank you everyone again. So this is going to move us now into our fourth and final module. So I see Vanessa is on hand to get us started here. So thanks, Vanessa, and I'll pass over to you.
Thank you, Fiona. So hello, it's Vanessa from the IFRS Foundation. We are now moving on to the final unit of this training, which focuses on the when and where of disclosure of sustainability-related financial information. So as with the last unit, we will have 3 main sessions here. To get us started, we will look at the location. In this session, we are looking to clarify where sustainability disclosures should be located. Before we dive into the specific requirements, let's think about sustainability disclosure in the context of a complete reporting package that is useful to the investors. So the requirements in ISSB standards are based on investor information needs, and they build on past standards and frameworks such as TCFD and SASB, which will similarly focus on investor needs. One of the major advancements is that ISSB standards bring the rigor of accounting as well as connectivity to the financial statements. ISSB and GI standards share some content requirements, such as what to report, but with different objectives. ISSB standards are laser focused on investors' information needs and decision making. For example, information about sustainability-related risks and opportunities that could reasonably be expected to affect a company's cash flow, access to finance or cost of capital. The objective of GI standards is to highlight information about a company's impacts, regardless of the implications for those impacts on the company's performance. So therefore, the ISSB and GRI are different, or you might say the complementary approaches to the materiality. So, for example, GRI approach is commonly understood among sustainability practitioners, whereas the IFRS approach is familiar to accounting professionals, finance executives, investor relations professionals, and relies heavily on the management judgments. So keep it in short, many of the impacts traditionally identified as material in the GRI standards may give rise to sustainability-related risk and opportunities that are likely to affect companies' prospects, and therefore investors need information about them. So given that we hear the references to different types of materiality from different reporting standards, so let's briefly recap here what we mean by material information for IFRS S1 and S2. As we discussed in our first module, information is material when it influences decisions of primary users of general purpose financial reports and informs their decisions about the following four contents. Firstly, providing for resources to the company. Secondly, buying, selling, or holding equity or debt instruments. And thirdly, granting loans or other forms of credits. And fourthly, voting on or influencing how management uses a company's economic resources. So deep dive in these contents. When preparing our disclosures, we need to consider the characteristics of the investors and the company's own circumstances. For example, different investors can have different and sometimes conflicting information needs. Sustainability-related financial disclosures are intended to meet the common information needs of investors. The important thing to remember is that materiality is a characteristic of information. The ISSB standards take a two-level approach. Which sustainability-related risk and opportunities would investors expect to affect the company's prospects, and then what material information do they need to base their decisions on? So to further introduce the disclosing material information, so IFRS S1 requires that material information be clearly identifiable and that's clear and concise. So material information, in other words, should not be obscured by other non-material information. So let's talk briefly about why is that important. Firstly, the location of sustainability-related financial information within the general purpose financial reports might vary between companies across different jurisdictions. And secondly, information designed to meet the needs of other stakeholders in addition to investors might be provided voluntarily or to meet regulatory requirements. The potential problem is that material information could be obscured because it is buried amongst immaterial information or because the report is poorly organized and material information is scattered throughout the reports. Just bear in mind, the company may not assert compliance with ISSB standards if a report is overloaded with irrelevant data or information, or if it brings information for different audience without clearly identifying material information for investors. That could happen if other standards or frameworks are mixed in. So especially if they are multi-stakeholder focused. So as we mentioned previously, in November 2024, IFRS has released educational material with guidance for companies on identifying and disclosing material information on sustainability-related risk and opportunities. And we will encourage you to look at and for further detail. So now let's jump to the sample to reflect your understanding of the disclosed information we just talked about. So the question is like, information should be disclosed in the annual report when applying standards if. So you need to select all the answers you think that are correct. I think for the interest of time, I think I'll stop the poll by this here. So it's It's good we can see a very strong answer to selecting A and B. Yes, but still we can see some like 50 of you have chosen C. The reason for not chosen C is that unless it has been determined that the particular values being exemplified are expected to have a financial effect on the companies, and this may not be the information that is used necessary for the disclosure. So the correct answer should be A and B. So it's good to we'll have at least like around 350 people like selected right. So now let's zoom to another. Let's move on. So now let's move on deep dive on where to report for the ISSB. So the disclosure under the ISSB standards must be made available at the same time and on the same terms as the financial statements. That's really important as part of the same general purpose financial reporting package. However, IFRS S1 does not have requirements on the exact placement of the information. That is, it does not say where within the reporting package the information shall be provided. This is designed to allow the jurisdiction to specific requirements on the location of reporting. The most important factor to consider here is to ensure that the sustainability disclosures are for the same reporting entity as the related financial statements. The sustainability disclosures are published as part of the entity's general purpose financial reports, and that at the same time as the financial statements cover the same reporting period. While many companies do continue to put sustainability information in the standalone reports, the ISSB standards require sustainability-related financial information to be included with the general purpose financial reports. So we suggest many companies have set some way to go to get the internal process and disclosure plans aligned. So now I hand over to Tiffany to bring us an example.
Great. Thanks so much, Vanessa. So rather than sharing a corporate example here, we wanted to provide an overview of current practices on where companies are actually reporting information. So this draws from the World Business Council for Sustainable Development, the WBCSD's 2025 reporting matters, an annual review of corporate reporting from a selection of global companies. While standalone sustainability reports, as you can see here, remain the predominant approach in 2025, comprising of 54% of reports in this year's sample. Combined reports of sustainability and financial information have increased by 11%. So this confirms the shift towards reporting financial and non-financial information within the same document in line with mandatory requirements. And the increase in combined reports, those that combine financial and non-financial disclosures, such as in annual reports, financial statements, or universal registration documents, is linked to the regulatory shift in Europe. And so in the region, 42% are combined reports, up from just 24% in 2024. Also, standalone sustainability reports, however, do still come in as the top form of reporting in the Americas, representing 81% of reporting. Then also, if we look at APAC, there is a mix of sustainability and also self-declared integrated reports at 58% and 35% respectively. So this is also a useful publication to refer to for more corporate disclosure examples. So we'll share the link. Oh, thanks, Fiona's already shared the link in the chat, so you can get that there, or in our slide deck. You can find this report and see how are people disclosing this information. Great. Back to you, Vanessa.
Oh, sorry. So moving on, let's briefly talk about the evolution of digital reporting and the ISSB taxonomy. So it's worth noting that the taxonomy is a general word for a classification system. And you may also have heard about sustainable finance taxonomies, such as the EU taxonomy. This type of taxonomy relates to classifying the sustainability of different types of economic activity or investment. Now, when we talk about the ISSB taxonomy, we are referring to a different type of classification system. We use the ISSB taxonomy to categorize information within the reports. Increasingly, corporate reporting is moving from PDF reports towards information on the web pages with structured data sets, such as those databases offered by the stock exchange or the regulators. So to respond to this reality, the IFRS Foundation developed the ISSB taxonomy. So the ISSB taxonomy provides identifiers or tags on extensible business reporting language, which is needed to make sustainability disclosure machine readable. So this makes it easier for the investors or the data platforms to take large data sets, like information from an entire industry, for example, or bring them all together to analyze them. And there are several benefits regarding the digital reporting. Firstly, it makes the reporting information easier to use for the analysis because data is structured the same across different business sectors or different geographies in the machine-readable formats. Secondly, tagging information potentially allows for automatic checks for the quality and the consistency. And thirdly, it improves the processing and report preparation as more data connection and management systems are compatible with digital reporting taxonomies. Finally, text can have labels or description in multiple languages. If you report your quantitative data in one language, someone speaking another language can also understand what it means. So following the discussion on the location and the timing, let's now think about ensuring efficient in disclosures. We have added this into the training because there was a common comment we found from the companies is that there is a growing reporting challenge. What we hope to highlight here is that when done correctly, efficiencies can be made to reduce that challenge. So firstly, it's important to understand what effect in communication looks like and what it is required. So often companies think that if they just put all the information they have into one report, then everyone will be satisfied. However, this would be against the core concepts, in particular the fair presentation. So IFRS S1 requires information to be clear and concise. So the clearest form of disclosure will depend on the nature of the information. For example, tables, graphs, diagrams, plus simplified text. To be concise, disclosures need to avoid boilerplate information, unnecessary duplication, and to use clear languages. And now let's deep dive in the quality of information disclosed. Let's spend a few seconds talking about the quality of information to reports and how traditionally the disclosure of sustainability information and financial information has been different. So the accountants in the audience are both properly familiar with the rigor that's required in the data connection, oversight, sign-off, and external assurance for general purpose financial reports. The same level of rigor has not been traditionally linked to sustainability information. For example, comparable information from the previous reporting period is a requirement in the ISSB standards, except during the first year of implementation, and it must be revised if necessary. As we discussed in the previous session, the ISSB standards require that reporting information shall be material and that companies provide connected information. So the connected information includes highlighting connections between risk and opportunities, the core contents, and of course, between sustainability-related financial information and the financial statements. So when aggregating the information, The items of information shall be aggregated if they have shared the same characteristics and disaggregate if they are not. So a company shall not aggregate information if doing so would obscure the material information. And companies should also avoid unnecessary duplication and cross-reference properly. So now let's deep dive in the cross-referencing. As you may have already noticed, there may appear to some overlap in the topics covered in the information disclosed across different reports. In fact, as IFRS 1 requires you to avoid unnecessary disclosure. For example, if you have the same governance approach across all sustainability issues, you need only disclose it once. Or if information required by the ISSB standards in another report that you publish, for example, in the related financial statements, then you can include material information in your disclosure by cross-reference, provided the other report is available on the same terms and at the same time. And finally, cross-referencing shall be applied constantly and transparently. It shall not result in the information becoming obscured or more difficult to understand. And now let me hand over to Tiffany to bring us an example.
Great. Thanks, Vanessa. So last example here, I'll just go through this quickly. This one is from Luxembourg-based multinational steel company ArcelorMittal. And it looks at cross-referencing what Vanessa was just talking about. So here they map the areas of their 2024 reporting output, which address the content elements or core concepts of the IFRS S1 standard, helping report users to navigate the different aspects of their reporting suite to locate this information. Now, this also serves to demonstrate how they're integrating their sustainability related disclosures into their wider business reporting. So, for example, by embedding information into the governance and risk management sections of their annual report, alongside the use of supplementary reports to disclose further information. So this can be a useful example for those of you trying to decide where to put information in your report. You'll also find in the handout some additional slides after this for your reference. So do go to our website and download those slides, and you'll find a little bit more information on things like commercially sensitive information and consistent disclosure, aggregation, etc. And I think, Vanessa, I'll pass back to you now.
Okay, thank you. So lastly, I would like to mention about some mechanisms that support the adoption. So ISSB has aimed to apply several mechanisms to support preparers to get started with the ISSB standards. So one simple thing to put in place was to adopt well-known terminology and concepts familiar to the preparers, borrowing from the IASB, for example. And many requirements in S1 and S2 are to be applied proportionately, recognizing companies will have a range of capabilities and preparedness on these issues. For example, qualitative scenario analysis is permitted, and you will see the phrase or reasonable and supported information at the reporting date without undue cost or efforts, or commensurate with skills and capabilities and resources in a number of places. And thirdly, reliefs for the first year of replication have also been introduced and include companies being able to limit the disclosures to the climate in year 1 and beginning reporting on their other sustainability-related risks and opportunities in year 2. And companies being able to provide annual sustainability-related financial disclosures with their next half-year reporting, rather than at the same time as the financial statements. And also companies not needing to provide disclosures about Scope 3 greenhouse gas emissions and apply the Greenhouse Gas Protocol corporate standard to measure emissions if they have already using a different measurement approach. Another relief allows companies to include greenhouse gas emissions information obtained from the companies in the value chain with a different reporting cycle. We have already mentioned a number of other sources of guidance and resources, including SASB standards, CDSB frameworks, and among many others. So the above reliefs proportionality mechanisms, and source of guidance are designed to enable companies to put in place reporting practices and structures to provide high-quality, decision-useful information. And jurisdictions are deciding when to mandate those adoption. But the standards were effective from 2024, January the 1st, and we know many companies immediately began preparing the adoption voluntarily. And now let's move quickly to two samples to check your understanding, to the reflection, to check understanding what we talk about this disclosed information. So for the interest of time, I think I'm just quickly get a little zoom stop here, but it's good. Yeah, many of you have chosen correctly. Like the correct answers is or A, B, D, but C, but still C is in like a few just chosen C, and now it's really clear that the information disclosed should be decision useful, material, and comparable. And misleading is like a negative word. You don't want to choose it. And another jump to another sample is testing your understanding what we mean by decision useful information. Yes, we can see like a similar trends among those five options. Yes, correctly. For the interest of time, I think we'll stop here. So the correct answers are all. It's really clear that like all those answers are like what we mean by decision useful information. Okay, now let's quickly jump to the last section of our units. And the last section of our unit, we focus on how you can ensure that the users of financial reports have confidence in the data you're disclosing. As we all know, trust is an essential component of sustainability-related disclosures, and increasingly so with the growing concern over the greenwashing. An important trust builder is showing data and trends over time. And IFRS S1 requires that you disclose comparative information for the preceding period for all amounts of disclosed, and for qualitative or narrative information as well if useful for the investors. And comparative information provides context, and it helps to indicate progress and underpins strategy and risk management. And it can be both qualitative and quantitative. And metrics disclosed by a company might be redefined or replaced over time, or the company might change its method for estimating a metric. So in these situations, it is important for a company to revise the comparatives to enable the investors to compare and analyze current period figures with the relevant period figures. So if you have new information for the last year, for example, you obtain the actual greenhouse gas emission data from your supply chain and that you have only estimated before, then you should revise the information and the information if it is material. And occasionally, a company's sustainability disclosure might contain material errors. In this situation, the company is required to restate these errors in the comparatives provided. And lastly, revisions or restatements are necessary only when there is a risk of material information being omitted, misstated, or skewed because of not revising or restating those statements. And finally, it's important to build confidence by providing clear statement of compliance. A company that complies with all requirements in the ISSB standards or even the release is required to make a clear statement of compliance. I want to emphasize that you can still make a statement of compliance if you are using transition release in the first year of reporting or if you were ever using any proportionality mechanisms. However, there are two exceptions where information could be omitted and you could still make a statement of compliance when there's like commercially sensitive information and when law or regulation prohibits the disclosures. So one exception is that You do not have to disclose information about a sustainability related opportunity that deemed to be commercially sensitive, saying that you are planning an acquisition and you don't want competitors to know about it. The standards provide a relief that allow you to meet the information provided the certain conditions are met. Note that this only applies to sustainability-related opportunities, not risks. So if this is a concern you have, so there is a further detail you can read into your handout. The second exception is that if you are prohibited by law or regulation from disclosing certain information. So lastly, to remember, the companies that are beginning to phase in the ISSB standards voluntarily and are only partially aligned on to them could not make a statement of compliance, but instead may explain where they are on the path, as explained on the guide published in the 2024 on the voluntary applying ISSB standards. So moving on, to wrap up the last unit, there's some things to remember about disclosing effectively, efficiently, and building confidence. Following the requirement for fair presentation in the conceptual foundations of S1. This include the fundamental characteristics of decision useful information, and that is relevant, and that is faithfully represent what it does by being complete, neutral, and accurate. And then there were enhancing characteristics of information that is be comparable, verifiable, timely, and understandable. Also, make sure information is provided so that investors can understand the connections between risk and opportunities, between disclosures about them, and of course, between the financial statements and sustainability-related financial disclosures. So finally, the ISSB disclosure should be for the same reporting entity and at the same time as the financial statements. And with complete material information, comparatives for the previous period, and our statement of compliance. You can find more in your slide handout and additional slide in this session with reminders of how to report effectively. And now let me hand over to Fiona for the wrap up.
Lovely. Thank you so much for that, Vanessa. And as we say, that brings us up to the end of our final module. So before we close off the session, we'll just take a quick moment now to wrap up on some of what we've learned here in this module. So firstly, we talked about where to report information. And what we want to highlight here is that it's the audience or who you are reporting to that's important to keep in mind. So with the ISSB standards, we're talking about the primary users of information being investors. So focusing on what's right for their needs is a key guiding point here. We then talked about efficiency, and I think a key takeaway here is that less is more. So the objective isn't to overload your investors with information, because actually that could be harmful and it could obscure what's required. So this is where using the standards as your guide will ensure you're focusing on that decision useful information that investors need. And finally, we talked about report user confidence. And we know that increasingly there's a lot of scrutiny on disclosures. So it's important to ensure your data is accurate and it's presented in a way that builds confidence among report users. And so that's where the disclosure plan that we've been working through in our exercises together, and you can take away to build out in the homework, can really help you to have a structured approach here. Okay, so we're coming towards the end of the session, so we're going to do a very quick look in Menti. So I don't think, unfortunately, we have time to do our exercise in detail, but I know since the question was open, a few of you had already shared your responses, so we'll take a quick look at those. But after that, we do have a final Menti question for you, which we would like your responses on. So please do have a quick look in Menti. So a few different techniques have been shared here, which are all really helpful to highlight. So great to hear about your thoughts on which of those different communication techniques, including structures, headings, indexing, combining sort of text with illustrations, having kind of tables and tabs that help people to see where they are in the report. Those are all great ideas, and maybe having a kind of a balance of data alongside narrative and using your website as well alongside your disclosures. So loads of great ideas there, everyone. Thanks very much for sharing those, and would love to have more time to go through them, but I know we've held you in this session for a long time already, so let's not keep you too long. The last question we have for you in Menti, which we'd love to get your responses on, is to just revisit that question that we started with the session on about how comfortable or confident you were in those different aspects of disclosure and the ISSB standards. So great if you can just let us know now in your response how you're feeling at the end of the session. So I think before it was certainly in the twos that we were at on the scale, and I now see most of you coming out more in the threes and the fours. So lots to learn, of course, and to continue to understand, but great to see that you've continued to build your understanding here. So I'll leave that Menti open for you to continue to respond on in the background, but thanks for letting us know your feedback there. Okay, a few final slides to wrap us up, and the all-important point, which I know you'll be wanting to hear about your certificates. So stay tuned for our final couple of minutes and we'll get you on your way with that information. So one final point just to mention is your homework assignment. So as we said, this is optional and there's no need to submit this to us in any way, but you can find the homework on the event webpage for today's session if you'd like to use this to continue to support your reporting journey. This is all around focusing on building out that disclosure plan for your organization. So encourage you to take that away to complete in your own time. I'd also like to just highlight a few key resources from the IFRS Foundation. First thing to mention is their IFRS Knowledge Hub, which is the regularly updated go-to place to find all resources from the IFRS. There's also 4 free e-learning modules available on the adoption of the IFRS standards, which you can find on the Knowledge Hub and linked in the slides as well. And just to very quickly mention a few key things from the IFRS Foundation team to stay informed about. So the FSA credential is a great way to continue to build your technical competence on this topic. So I encourage you to check out that qualification. There's also 2 other things to be aware of in terms of the IFRS Sustainability Alliance as a group of organizations networking and sharing their practices on this topic. And finally, just to be aware for organizations who would be looking to use the ISSB standards within their commercial offerings, there's access to information there on the licensing approach for that as well. Final quick highlight from the IFRS is their upcoming conference in London, which you can also register for at the details here on the slide, which you can find in your handout too. And if there is a link to that from the IFRS colleagues, feel free to share that in the chat as well. A final couple of quick mentions, the IFRS Beyond the Balance Sheet program, which Yulia mentioned to us at the start of the session, is a great go-to for lots more learning and support across sustainability and governance topics. So I encourage you to also follow the links in the handout there. And we've already shared with you the SSE toolkit, so you can find that in the slides as well. Okay, in our final moments, I know there's a big important question we still have to cover, which is how to get your certificate. So a big well done and thank you for being in this training session with us. As a merit for that hard work, we'd love to issue you a certificate and also to receive your feedback on the programme. So to get your certificate, you'll need to fill out the feedback form, which Landon has just shared the link to in the chat. I'll ask you just to keep posting that a couple of times, Landon, please, just because I know the chat will keep moving. And what we'll also do is within 24 hours of today's session, you'll receive an email from Zoom, which will provide you with that link again. So don't worry if you do miss it in the chat, you'll also receive that on email 24 hours time from now. If you fill out that feedback survey, we'd love to know your thoughts, but we'll send you a certificate to the email address you provide on the survey as well, within around a week of taking part in the training. So please be patient and give us a little bit of time to send your certificate out. Do check your spam folders as well if you need to. And finally, if you can't get your certificate after about a week, you can reach out to us at the details we provide at the end of the presentation. But I know we're up to time now, so in the interests of giving everyone a little bit of their day back, we'll just say a final thank you, firstly to the SSE's official supporters, who are a group that help make this programme possible, and in particular to our partners for today's training programme at the IFC and the IFRS Foundation, and especially to Vanessa, Robert, Rebecca and Visvesh for joining us today and sharing their expertise and answering all your questions as well, which has been much appreciated. So final closeout, just to say a big thank you to all of you as participants for joining us today. We hope to see you at a future SSE workshop, and we wish you a good rest of your day. Thanks very much, everyone.